We can go 11 to 12, and then 12 to 12:45 will be lunch. And then Marquette will be 12:45 to 1:45, and then everybody will be gone. It'll just be us, and we're going to spend the next however long it takes to figure out who you want to walk down the aisle with and get married to, or if you need more information. But I think usually 90 to 95% of the time, folks can make that decision at the end of this meeting. And then we always tell people to sleep on it. And we're going to negotiate fees and things like that. I mean, some fee, like Marquette fees are so low, there's no real wiggle room. And I noticed that NEPC came back with a 1-year fee break as well when I looked at their presentation. So there's already been some fee, at least at NEPC, because you guys had run to a minimum fee. You weren't big enough until you get to about 55 million. So they're going to drop that 1-year fee. They're still one of the higher ones, and definitely after year 2, the highest one. We'll talk about all that, and hopefully you'll have that book that we did, and we had the selection meeting. It has a lot of the metrics on there, and I'm going to continue to come back to that on this hour wrap-up at the end. So that's the whole 4 or 5 hours we're spending together. Any questions?
Are we going to try to get through all 10 of these questions, or should we
We're
say
gonna
to each
try.
other the top 3 things we really want to learn about are 1, 2, 3, and what's the best way to do that, Brad?
Just to be interactive and ask questions as you go. We don't need to follow the script of 10, let's do these 10 questions like robots or anything. So just what's important to you as a group. I mean, these are 10 questions that you guys put up and we help with, but there's got to be more things in your mind that are important as well. I know, the people here are the relationship managers. These are the people you're going to be working with. I know it's a little bit like speed dating, that you only get an hour to see what the chemistry is, but you should get a good feel for what they're like. So there aren't any real, there are a couple senior people coming. I know NEPC brought us a very senior person. Well, they all 3 have. They all want to show us very senior person, and but you really want to talk to the relationship manager and see what that chemistry is. In every book, I know that you can, talks about who the relationship manager is kind of big. That would be your lead.
Okay, perfect. So when they come in, should we all get up and shake their hand?
Yeah, it's always good to introduce yourself and just go through the room and just introduce you, then hand it off to them. So I'm just going to be on the fly on the wall. I've heard these people present way too many times, and if they say things stupid, I'll make sure to call that out and keep them on point in terms of time, let them know when it's getting, close to the 50-minute mark. Sort of try to wrap it up. Yes, it'd be good if you introduce yourself. If you want to talk a little bit about the history, if you want to find a point person that just kind of talks about the history a little bit, that's in the RFP, they know it, but a refresher would be good. You want to kind of start to build a relationship a little bit.
Okay.
Greg, you mean to get them, or are you going to go get them?
I was going to.
Okay. If y'all are ready, I'll get Northern Trust. They brought hard copy books for you as well. So they brought a book, and then you got the electronic version, right?
Yeah, I'm just going to have them put up the
Okay. And they brought hard copies. All right. So is there anything else you want me to go get them? Are y'all good?
Yeah.
No, I mean, they brought hard copies, and I think everybody has it on their iPad or device. Okay, they're not going to.
Oh, they're not going to do that? Okay.
Say the same to you.
All right.
You don't really need to.
Okay.
Okay.
Be gentle, Rick. Be gentle.
Rick's the most gentle.
I'm so sad for Kevin to not be here. I bet he was sad too.
They used to call me Gentle Rick at the.
That was our nickname, General Rick.
I never heard you call that.
Yeah.
I think I heard some laughs from over this side of the room for sure. The staff ends of the room got. I even got a giggle out of Jennifer over there.
Here they come.
I'm going to have them.
Where should we sit?
Good morning. Where would you like us?
In the
You
center?
guys can. I don't know.
there?
You guys, yeah, up here. I guess up on
Okay.
Yeah, the pulpit.
Thank you for being here. We appreciate y'all coming in.
Appreciate you guys' time.
Thank
Yeah,
y'all.
thank you guys.
Yeah.
So they're,
What about you and Ronnie Martin?
Oh, yeah.
General Ronnie, General Rick. Just people wanting to get along.
So we have hard copies.
Do you want to sit here?
Is this what you, is that with the, on the attachment that you guys sent us? Is it the same stuff?
Yeah.
Starts like this?
Will do. Yeah. You have a hard copy if you need it, and your electronic version as well.
We got a hard copy.
I'll take your
if
hard
it makes you
copy.
happy, we'll take it.
Some people still like to write on the book.
Yeah, I wrote on my, printed it off so I could write on it. I was reading through it.
We try our best.
Went to this effort.
Thank you. Be careful.
Yeah.
It was like a Senate hearing.
Thank God.
Hopefully it won't feel like a Senate hearing here in a little bit. You get that?
We won't take the fifth on anything. We'll answer the questions.
So in the folder, there's actually a separate cutout of the questions so that you can refer to it and you kind of check things off as you go or take notes. Thought that might be helpful.
Yeah.
How many of you have been to Murfreesboro before?
First time.
This is my first trip.
This is all of our first times. Yeah.
We've been to Nashville. I have a niece that lives in Nashville, so we're down here for the wedding and been down a couple of times, but first trip to Murfreesboro.
Yeah, Nashville's pretty good, but Murfreesboro.
That's where it's
So
at.
I've actually got a twin brother, and he lives in Thompson Station, so I was staying with him.
That's nice. Good.
Yeah, it's a pretty nice area.
Did you spend Thanksgiving there?
They actually came up to Chicago.
Oh, wow.
Yeah, they've got 3 boys. It was nice. Nice time.
Cold enough down here, so he had to go.
There's like a 20-degree difference between Nashville area and Murfreesboro to Chicago. It's pretty cold up there.
So are you guys to blame for this cold weather? Because it's normally not this cold this early.
And we're blaming
bring it in.
Minnesota.
Right.
So it's
Yeah,
like,
we'll blame, right, we blame Minnesota. So it just goes up the chain. So
Exactly.
So we got our first snow right after Thanksgiving, and it turned pretty cold. We've actually had a pretty nice thaw. It was in the 40s, which is pretty good for November for Chicago, and then the snow came Sunday, and the cold came right with it, and it was just like, ooh, I guess we are.
All that's they showed on the news.
Well, I'll start the introduction since I'm over here on the far left. You guys know me, Brad Alford with Alpha Capital, and then hand it off to Craig and go around the room.
Craig Tyndall, city manager, and kind of administering the trust from the staff side.
I'm Ann Davis. I'm a member of the board, and I also serve as the president of the Christy Houston Foundation, which is a private health legacy foundation here in Murfreesboro.
Richard Stone, I am the market president for what is currently Capstar Bank, or what soon will be Old National Bank, which you guys may be familiar with, First Midwest and Old National. So I'm a simple banker, so talk slow for me.
Hi, I'm Sean Applegate, also on the board, and I'm the Chief Legal Officer for Venture Express, which is a transportation, trucking, and warehousing company headquartered here in Murfreesboro.
And I'm Rick LaLance, board member and former council member for the city of Murfreesboro, and currently a Raymond James advisor here in town. And we've got a couple.
We're missing a couple. Steve might show up in a little bit. Steve is CEO of NHC, National Healthcare Corporation, based here in Murfreesboro. And Kevin Gentry. Kevin is I think he's Chief Administrative Officer. I don't know his exact title, but he does administration for the state's investment pool.
okay.
And he had meetings today, so he's out right now. So,
And Lee Moss.
but might slip in, and Steve might slip in a little bit.
As well as Lee Moss, who is not here.
Lee?
And Lee Moss. Lee Moss is a retired bank president for Franklin Synergy before they merged with, you can't keep track of all the mergers, First Bank, and he's out with some health issues right now. So, okay, he'll come. That's our board of trustees.
Yeah, thank you. Thank you.
Well, thank you so much. I'll kick things off for us over here. My name's Lindsay Frenchhawk. I know Brad very well from just business development efforts here at Northern Trust. I'm a senior investment specialist on the OCIO team. So what that means is I spend a lot of my time talking to prospective clients that are interested in OCIO, that issue searches, and I work with our investment team to really understand the challenges that the client has in their current status and how we can help make life easier for them. And so I pull together the team, we work on the proposal, I coordinate with the search consultants, et cetera. And so on behalf of the team, I just want to say thank you so much for having us here. We already really know that we love the biscuits that we had this morning at breakfast at one of the local places here that we hadn't been to before. So we were joking about that. But it is an honor to be with you today and to be in consideration for a partnership with your business, and we want to thank you for that, but we're also so incredibly excited to have that opportunity to tell you why we think we're the best partner on this very important journey with the trust. So with me today we have, I'm going to start on this side of the room, Mike Nieves. And Mike works on Northern Trust Asset Management's public fund team, and so he covers the Midwest and the Southeast, works with a lot of public fund clients, more so typically on the product side, as we are a large asset manager, but he is a supplementary resource to our OCIO clients. So thought leadership from the top of the firm, if you all would have a question about other ancillary services outside of the OCIO framework at some point, we'd be happy to facilitate that, and Mike would be a part of those conversations. But as far as your day-to-day goes and who you would be talking with and working on the investment policy statement and education and all of that, it's Kathleen. So Kathleen Walters would be your primary contact. She's a senior client investment officer. You can think of that as portfolio manager. I know there's a lot of different, terminology you may hear today, so you could just think of her as your primary contact. Kathleen has only been with us for about a year, but it was very intentional bringing her on board because of her very impressive public fund background. She's got about 14 years of investment experience. She has started up similar trusts from the ground up at least 5 other times with different public fund clients. So the situation that you are all in today and contemplating on, what type of investments, how do we develop an investment policy statement, how do we stay educated and informed, Kathleen has been through that process a number of times, and she's very excited to be a part of the team and to lead the team. Hello.
There he is.
Hello.
Good morning.
Good morning.
Ready to be late?
That's okay.
Just got started. Good.
And then next to me, we have Jim Hayes. So Jim leads our retirement OCIO practice. He's got over 35 years of investment experience, global leadership positions at Western Asset Management prior to Northern Trust. He is the former director of fixed income for Ameritech. And prior to coming back to Northern Trust 8 years ago, we call him a boomerang. So he started out his career at Northern early days and then kind of bounced around. But most recently at Allstate on the plan sponsor side, the asset owner side, making these decisions on behalf of the company for their defined benefit pension plan. And now he leads our team, so Kathleen reports into him. He is a voting member of our investment oversight committee, and why that's important is because that's the governance framework that really manages all of the portfolio governance considerations for OCIO clients. What that really means is he's on the hook for your satisfaction. So Kathleen's going to be your day-to-day, but he is responsible for keeping our clients happy at the end of the day. So thank you for submitting your questions in advance. We're going to hit on all of those. Maybe before we get into that, if we could just share a few snippets on Northern Trust as an organization. I know we are a newer name to some of you. We'd really appreciate that. So I'm going to kick it over to Mike to just go over the Northern Trust organization.
Thank you, Lindsay. And thank you all for your time today. So as Lindsay mentioned, we are the asset management arm of Northern Trust Bank. Northern Trust has been around for more than 130 years. We're headquartered in Chicago, and the team that would be responsible for the MCIT relationship would be based out of Chicago as well. Our success throughout the years in being one of the strongest and most stable financial institutions in the world is really on our focus, right? We're focused on 3 core areas in our business, and that includes wealth management, asset servicing, and asset management, which is what we're here to talk to you about today. With regards to our asset management business, 77% of our clients are institutional, so there's a real focus on the institutional segment. And within our OCIO practice, we're actually the 5th largest in the United States in terms of OCIO providers. And we manage about $139 billion in assets for the OCIO practice. And we've also been doing it for more than 40 years. We were doing OCIO before anyone even knew what OCIO was, so we're really proud of that fact as well. One other point that I'd like to make is Moody's, they recently reaffirmed Northern Trust's senior debt rating to A1, which is the highest rating that's attainable by banks. And it's just a real testament to our prudent risk management. We're very stable, and we're always risk averse when it comes to our operations. So moving forward, I think we're on page 6, or is it 7 on the actual deck? This page just really highlights our relevancy in the public funds space. As Lindsay mentioned, I'm Director of Public Funds for Northern Trust Asset Management, and I cover the state of Tennessee, so you could think of me as an additional resource to Kathleen, who would be your primary contact for any of your client servicing related issues. Some points that I'd like to highlight on this page here. We manage more than 250 client relationships for public funds. That amounts to north of $155 billion in total assets that we manage for the public funds space. We're also members of and have partnered with some of the more prominent and well-renowned trade associations in the public fund space, and that's both at the national and at the local level. And in terms of thought leadership, you know, the public funds team, we're constantly talking to our clients and trying to notice and keep track of key themes and trends in the public funds space. So we take those conversations, we bring it back to our marketing team, to our investment strategists, to try to come out with, you know, thought-provoking and well-timed thought leadership pieces that really try to address the concerns and what's really top of mind for public funds to help them out with their investment journey. So we're doing that on a constant basis as well. The next page, before I turn it back over to Lindsay, just talks about, you know, as a large global financial institution, we feel a great deal of responsibility to working with local communities in which we operate. And so this page really does a nice job of highlighting our partnerships with several prominent organizations whose mission it is to bring about much needed resources to underserved communities. We've been a leading CRA wholesale provider now for decades, and we're really proud of the fact that we've been recognized by the CRA with an outstanding rating for 27 years in a row.
Thanks, Mike.
Yeah.
I think that's just helpful if you don't really know us as an organization to understand beyond the investment expertise, you're working with a large, stable, conservative financial institution that has aligned values. So we just wanted to hit that up front before we jump into question number 1. So at this point, I want to turn it over to the star of our show today, Kathleen, and we want to talk about your questions on the final portfolio recommendation, what it's going to look like, and what is the transition path to getting you there. So Kathleen, could you take it away on slide 11.
Thank you, Lindsay, and thank you, board, so much for having us. I'm very excited to be here today. As Lindsay's mentioned, my background is working with public clients. That's where I've spent almost my whole career. And I've done this exercise with 5 other public entities who were either creating trusts and funding them for the very first time, or perhaps had a trust that existed, but were only using the types of investments that are more common in public funds, treasuries, agencies, very liquid, low risk. So going through the process, establishing a more diversified investment program is something I'm very familiar with. One of those 5 was, in fact, an entity very similar to the city. They were a local community college who sold an asset, went to the state, got permission to create a more diversified investment program. So a very similar scenario. Jumping straight in, specific to your question, what are the steps? Well, the most important step and the first step in creating any successful investment strategy is understanding the client and its mission. So we did some research before coming here today. We read through all of the wonderful information that you provided us, the state statutes, the RFP, the trust document. I spent some time on the city's website. You have a wonderfully organized website with lots of information, trying to understand the best we could about you and your goals. And it's with that framework that we created for you a sample portfolio. I will point out on page 11 some of the information that we were able to gather about you, the important mission, the individuals who are responsible for oversight. Some of the things we learned, for example, is that the trust would like to follow the requirements and limitations that are also imposed on the state retirement system. So we had that in mind as we created your investment program, that you have a goal of being similar, have a portfolio that is similar in nature to what they do. We know that your portfolio is $52 million in size. It will continue to grow through cash flows every year till 2035. This, too, is very important when you think of your investment strategy. Cash flow needs, the liquidity needs of the trust can impact and should impact what we do for you. For example, one of the things we noticed is that you intend to draw on this trust in April, and your contributions will come in July. So if we were selected as your investment manager, one of the things we would do is we would talk and see if there was any ability to line those up. You will be net contributors to this trust for the next several years. So if you can pull the draw after your contribution, you'd be in the nice position of not having to sell any investments. Now, we understand for a lot of reasons that might not be the case, but it's certainly something that we would talk about, because if you had to sell securities prior to your contribution, we would want to think about liquidity needs, how to place those funds so that we can sell and meet those. We also see from your trust documents that you have a goal of spending about 5% of the value of your trust annually. So as we created a portfolio for you, we took that 5% spending goal, we added on 2.5% for inflation, and we designed a portfolio that we think will statistically, or the models predict, can get you to that 7.5% return goal. So step one is understanding you, building a strategy that meets your specific needs and restrictions, and then we model that with what we know about the market. So on page 12 here, it's a very interesting time to be an investor in the market. If you think historically, what's gone on in the last 10 years is likely a scenario that's very different than what we think is going to occur moving forward. On this chart, we've included lots of information. On the left, we've broken this out into the more traditional asset classes. The publicly traded stocks and bonds are listed on the left. Thinking about what's happened in the last 10 years, interest rates were very, very low or rising over that period of time, so fixed income as a contributor to total return was not a very significant factor. You can see U.S. aggregate bonds there listed at 1.5%. But if you marry that, the stock market over the last 10 years had an exceptional run, over 12.5% for U.S. stocks, global equities, over 10% returns. So a diversified portfolio that was trying to get to a 7.5% return was able to do so using more traditional asset classes. Publicly traded stocks and bonds likely got you those types of returns. Unfortunately, past performance is not indicative of future results. So as we create a portfolio, as we create a strategic asset allocation for our clients, we take Northern Trust capital markets assumptions, the assumptions of our team on where we think the markets will go into the future. And that's why I want to draw your attention to the light green bars on this page. And one thing you might notice is that our expectations going forward are a bit conservative. We think the stock market over the next 10 years or so will return about 6.3%. So in the case of the city's trust, we don't imagine that you could get to that 7.5% return using just publicly traded stocks and bonds. In order to get to that higher level of return, we have modeled a portfolio for you that includes a much more diversified set of asset classes, more sectors. Some of those are listed here on the right. Now, a few of these, like real estate, listed infrastructure, natural resources, these might be less familiar. One of our roles as CIO would be to sit down and explain these types of asset classes to you. We want you to feel comfortable with the portfolio we designed for you. Every investment that we would consider has their own risk and return profile. And up front, we would go through all of these and create a plan and execute a plan, document a plan that you feel comfortable with. So based just on what we think is a reasonable expectation moving forward, what we believe is true for you as the city, we've outlined a portfolio on page 13. Again, you can see from this pie chart, it's very well diversified. We have types of assets, stocks, bonds, publicly traded, privately traded holdings, It is about 50% allocated to those more traditional asset classes, publicly traded stocks and bonds, and 50% into the more diversified asset classes. This particular portfolio that we've designed as the initial sample is a mixture of active and passive. We do have about 50% passive in our initial sample portfolio. The return expectation that we think that this portfolio has is listed there on the right. 7.5%, 7.51% to be precise, is our expected return from the modeling. The associated risk with that, listed below, 13.8%. That is risk measured by standard deviation. You can think of standard deviation as a volatility measure. When we model out the range of outcomes, about 2/3 of the outcomes land plus or minus 1 standard deviation. So again, looking at this chart, you can see it's very broadly diversified. Income-generating asset classes, which would be your more fixed income asset classes, are listed on my pie chart. If you look basically noon to 3 o'clock on that pie chart, you see strategic lending. That would be more private debt, so private fixed income, traditional fixed income, U.S. fixed income. We do have an allocation to high yield right now. We think high yield is an excellent diversifier at the moment. Because interest rates have come up so significantly the last few years, high yield does provide a pretty attractive income-generating asset class at slightly lower risk than equity. So we are favoring high yield in a lot of our portfolios at the moment. If you continue along the clock here from 3 o'clock down, you can see some of our return-seeking asset classes, your more traditional stocks, U.S. stocks, international stocks. Again, knowing that you want to keep a portfolio similar to the oversight restrictions from the state on the retirement plan, we have your international stocks at 15%. Continuing on, we have real estate investment. In this particular example, we would target private real estate, and we have the managers listed on the next page. I'll talk about that in a minute. Again, I mentioned natural resources and infrastructure. These may be types of asset classes that are less familiar to you. The way that we access these are not through commodities or futures, as you might imagine. We actually implement this using strategies that buy equity of natural resource companies, so a mining company, or equity of a company that does infrastructure work. So these are equity strategies that have those exposures. And we think that they make sense at the moment as risk mitigating tools, and partly because they're good hedges against inflation. Inflation is a very big topic right now, just in general and as we live our daily lives, but also very important in investments.
Your board.
Oh, okay, thank you.
We thought there was a question.
I'm assuming that's what that is.
So again, the
Not sure what that is.
I'm not sure either.
Sounds like it's in the room.
Can you all hear Kathleen okay? Or should she pull the, okay.
Okay.
No, you're
What I'm
good.
hearing
Okay,
might be
good.
different than what's projecting, so I just wanted to make sure.
I'll get Chad, Rick. It's all right.
We're waiting, instead of buying the trees and the different entities, you're buying equity in the companies that do work in those areas.
Correct. So think cell towers, gas and utilities, gas transmission lines, airports like we have here. Anything, and we like the equity side of it because they tend to be very yieldy. They throw off a lot of cash flow, so they throw off a lot of good dividend yield. Oftentimes, there's inflation, cost inflation escalators in the contracts already, so that's where you get some of the inflation protection from that. And again, they just have lower correlation with global equities. And so when we put together a portfolio, we're thinking about, okay, we need a return-seeking bucket. Think of that as your global equities. And then the diversifying assets that Kathleen has talked about, these are assets that we believe will help you get to that 7.5% return, as you can see from some of the bars on the chart. But they also have a lower correlation with global equities, and so it brings down the risk of that portfolio. It brings down that standard deviation. And then we have the fixed income assets that are going to throw off income, and we've put in there, global ag, high yield. We really like high yield. It's a much different asset class than it was 10 years ago. it's a little bit of an oxymoron to say it's a higher quality, below investment grade asset class than it was, but the significant change in the number of companies that are single B versus triple C now has really moved to a higher quality. And so we think companies have, the balance sheets are pretty good, cash flow coverages are better than they've ever been. Default rates are going down, and there's been a lot of refinancing that's already taken place in this space in the low interest rate environment that's kind of going to protect them in terms of coverage of having to refi at higher rates in the next few years to come. So from that standpoint, we think the companies are in pretty good stead, and it throws off about an 8 or 9% yield. And so that's going to help us get to that 7.5%. And so that's why that's a combination of one that will throw off cash flow, but then two, does have a lower correlation with global equities, and it's quite a favorable asset class at large right now. The other thing, let me point out too, this was the clean slate portfolio, so this was best ideas. As your OCIO, as your fiduciary, we're going to bring you our best ideas. And we're in partnership here. So you may not agree. You might say, Jim, we have no appetite for high yield whatsoever. We'll talk about it. But at the end of the day, if you don't want something in the portfolio, it doesn't go in. We're not here to force a solution on you. We're here to kind of bring you our best ideas of how to get to that 7.5%. But this is a partnership. Nothing happens unless we're all on the same page. And that'll all be spelled out in the investment policy statement of what asset classes that you agree to, what our targets will be, what the ranges around those targets will be, and then what authorities are you giving us then to trade around those activities, whether it's opportunistic or it's to, re-rate on a strategic basis. Something like a new asset class, if we were to come and say, if you'll notice, there are no hedge funds included in the solution that we've put forward here today. We just think right now the expected return of those going forward really isn't going to help you, in our opinion, get to the 7.5%, and we think they're rather expensive as a way to get there. We think there are some other better alternatives to spend your fee dollars on to get to a 7.5% return. But if we were to suddenly come back and say, look, the landscape is changing in this space, we think we'd like to include it in the strategic asset allocation, we would come to the committee with that recommendation, and that's something we would expect the committee to have to approve or vote on, and then we would amend the investment policy statement. But know that we are working in partnership together, and just really think of us as an extension of your staff. We're kind of carrying out, while we are providing the advice, we're carrying out the wishes that you would like to see in the portfolio as well.
Can I ask a quick question, just from the
Sure.
comment that you made about sort of being similar to the Tennessee state plan?
Yeah.
Do you mean that in terms of, it's just the way I heard it when you mentioned how much you have, how much we put on this pie chart in terms of international equities? It sounded like you said that we have 15% in international equity because that's similar to what the TCRS plan looks like. Is that because that's what their allocation is similar to their allocation, or just because I think what we were talking about is kind of the overall asset classes and that sort of thing, certainly not to be next to their allocation?
Oh,
Right.
sure. It's your investment statutes. These investment statutes that the retirement system follows is limited to 15%. So my thought was, if you're interested in being under the same sort of guidance, you want to follow the guidance the limitations the state has put on the retirement system, then the maximum that you would consider would be 15% in international stocks.
Would you guys generally be more than 15% with an expectation that's exactly the same as U.S. equities?
Yeah, right now we would, if you said what's your best thinking, this represents our best thinking. So we would be at 15%, and it's not, again, reading the statute and being aware of the statute, but that did not drive our decision to be at 15%.
That's what.
So from that, we did take another look at the portfolio with a more constrained view of the statutes, and that portfolio falls a little short. It falls about 7.25% return with slightly lower risk. And so you can't, if you were to follow those statutes strictly, we don't think you can get to 7.5%. And so that's why this is our best thinking unconstrained. That's what's driving our we'll talk a little bit about our capital markets and how we get to the decisions we make in terms of optimizing. That's what's driving the decision to be in 15%.
Craig, you'll maybe help me remember this, but it was my interpretation kind of the discussion that we have about the TCRS was that more kind of from a political standpoint in terms of the council when we built this and all that kind of stuff was just that we didn't want to be going way out of the box and all of a sudden show up with 100% in hedge funds and
Right.
Absolutely.
Absolutely.
right. I mean,
So that's why we tried to get very familiar with what those statutes were.
I think we had to have it. It doesn't have to exactly match up, or does it?
It doesn't have to match up what they're doing now. The comptroller, if I recall correctly, the comptroller was the one that imposed upon us to follow the statutory limitations that are set on the trust. We don't have to follow where they're at now, but there are maximum limitations on each category, and those are built into statute.
Okay, yes.
So that's where that came from.
So, for example, let me use high yield as the example. We didn't see an explicit okay of high yield in the statutes, but we would consider it to be a prudent investment the way we're using it here. That's something we would probably talk about, whether that was allowed. And if it's not allowed, it's not allowed, and we'll make other accommodations in the portfolio. But that's where we would probably differ. I think that's the biggest one. The other one was probably just, since we are using the equities in global listed infrastructure, those are already equities that are sold around the world. It's just when you put them together, they have characteristics that we think benefit the portfolio. So again, some of this might be interpretation, and some of it, we need to probably discuss. But again, if we took a more conservative view, we think you'd fall short at your 7.5.
Those are things we can certainly talk about. And from my conversation with the comptroller, I think we're okay being outside of that. I think what I would say is that the TCRS stuff is more a guideline than a rule.
Got it.
So to
Sure.
speak, right? I mean, if you know that movie, I mean, it's kind of, so I just, I just wanted to kind of make sure, though, how specific you are to the allocation versus the limitations, and so I'm good with it.
Yeah, so again, long story short, those are driven by our, investment process that we'll talk about in a couple of pages here.
All right.
Since you're interrupting here, it's been a while since I took. Been a while since I took statistics. So on page 13, the 7.51% expected return and the standard deviation of 13.8%. I think I heard you say that 2/3 of the time your return will fall within plus or minus that standard deviation. So that's 13.8% plus or minus the 7.51%.
Correct.
So based on this modeling, we should expect 2/3 of the time the return to be between 6.47 and 8.55%. Would that be correct? I mean, that's my math for the 13.
Yeah, right, negative,
Yeah.
negative.
Plus or minus.
Yeah, plus or minus, yeah.
So a negative 13.8% would be a 6.47% return. Positive 13.8% of the 7.51 would be 8.55. So in that 2/3 of the time would be.
So positive would be 21, right, it could go plus or minus 13%, right? So you could be 7.5% plus 13, 7.5% minus 13.
That's what I did.
Yeah, that's
okay,
right,
got it.
yeah.
Oh, okay, all right, got it.
Yeah.
Thank you.
In the interest of time, I'm going to keep moving. We have unfortunately only gone through one question here, and we have about 30 minutes.
Well, we're here to answer what you guys want to ask us.
Right.
So if you want to spend time, you have questions, we're happy to answer these questions, and then we can
Yes.
breeze through the rest of this.
I know this section is probably specifically very important to you, so we can spend as much time as you want. On page 14, for example, we have more information on why we think some of these diversifying asset classes make sense. Jim and I have already touched on them. And if you have specific questions, I'm happy to address them. If not, I can go straight into what a sample portfolio might look like with some investment managers. Okay. On page 15, here is one potential portfolio. So we, as your CIOs, would be very flexible in implementation. We know you have a question in the deck that we were planning on addressing, and Lindsay will address that in a minute, about proprietary products. And I want you to know that we have an open architecture. We will implement this strategy in any fashion that you think is appropriate. We have clients that don't allow us to use Northern Trust products. We have clients who prefer us to use Northern Trust. We will create a program that you are comfortable with. So There are two two manager lineups. Option A listed on page 15, and option B, the following page. And the difference really is the implementation for the alternative investments, the private equity and the strategic lending, whether we're using 50 South, which is the Northern Trust product, or whether we're going to use a third-party manager. Again, we will implement a strategy that's custom to the city and what you are comfortable with. Given the size of the trust, these strategies are funds, mostly mutual funds. There's some passive strategies in here, there are some active strategies, but it is not likely that we would use separately managed accounts when your account is this size. That is something that we would potentially consider as you get larger. But separately managed accounts and some of those other types of investment vehicles have high minimum investments that you wouldn't quite meet. Moving forward, so very specifically about the...
Quick question on option A and B. So option A is using all external products, and it's 38 basis points. And option B, it goes up to 42 basis points using your products. Why does the fee go up using your products?
So our private equity is more expensive, but it does not include, 50 South Fund of Fund, the private equity core fund has no carry. So as you know, some of these fees are a little bit complex and complicated. So I wouldn't look at it as an apples to apples purely comparison, but to make it simple for consideration today, these are just your core investment management fees.
So before we flip on, you good with that? Does that answer your whole question?
Yeah.
Yeah.
The footnotes do talk about what those might be as well.
So the, basically, the only thing you guys are adding in there from a proprietary standpoint is just on the private equity and the strategic lending is the Northern Trust.
Right, because we have those capabilities right now. And also, in addition to that, if you were okay using our 50 South products, we would not charge an OCIO fee on top of the 50 South.
Okay, so tell me kind of look, as I was reading through all these different, from the different providers, these things are formatted in a little different ways among the providers. So I just want to make sure I've got a very apples to apples idea of the fees. So let me just get that out of the way right now, just while we're talking about basis points up here. If we look at option A, I just want to get total, what is our picture of total fees? This 38 basis points, I'm assuming that includes all just the internal, like expense ratios of the 4 basis points of the Vanguard Total Stock Market Index, and then the whatever T-row is going to be a little bit higher. The average is 38 basis points. And then is there an OCIO cost on top of the 38 basis points from you guys, which is how much?
Yeah, that's correct. So your investment management fees are separate from your OCIO fees. So you don't think of this as kind of like a bundled approach, but you should do the math to consider what the total fee will be for each provider. So 38 basis points investment management. We have a slide that has our OCIO fee, which is a tiered fee schedule, so that as you get bigger, it will become less expensive for you. Starts at 25 basis points on your first 100 million. This is on slide 49, by the way.
Yeah.
15 basis points on the next 150 and 10 on the balance. So right now, that comes out to about $130,000 for your year one portfolio.
Where is that slide?
Slide 49.
49?
If you have
I've earmarked it, but I just...
the deck with tabs, it's under tab 12.
All right.
But what to consider is, again, the all-in cost. So if you utilize, if the portfolio that we implement includes 50 South products, which we feel is competitive, is suitable, has a great track record, we feel like the access is really great there. But again, that's up to you. But if you would be okay with using 50 South Fund of Funds, we don't apply this OCIO fee to those assets. So right now, year one, that's 24% of your portfolio, would save you $30,000. So whoever else you may work with who applies the total OCIO fee on an external, again, fund of fund situation, just consider that all-in cost whenever you're doing your calculations. Is that helpful?
So really, the all-in cost on option B is less than option A.
It could, yes.
Yes.
Yes. And the other thing to
If you get that
consider,
$30,000, okay. Got it.
So, gosh, how am I going to write this?
that's also because of the size, as Kathleen mentioned. We have direct programs with private equity where there are no, fund-to-fund charges. As you guys grow larger, that is our intention. But right now, given the size, it's the most effective way to get you exposure in the private equity markets. That being said, the other component that you may want to consider, there were some questions about custody services in the RFP. If you select us as your OCIO provider, we're offering a discounted custodial fee of $65,000 a year as a minimum annual fee. So things to consider, we're happy to work with any custodian you choose. We're custodian agnostic. About 70% of our clients do utilize us for custody and OCIO, just because there are efficiencies and scale there.
All right, so this one's on a little different note, but it's on the same slide. The Vanguard Total Stock Market Index, in terms of it being kind of a best idea, so what my concerns with that is that it becomes a little difficult to kind of manage between large caps and mid caps and small caps and growth and value. And if you got to, that basically says to me that you're just going to go with whatever the index says on basically all of that, rather than have any opinion on any of that. I guess just at the very least, I would prefer to see that, if just separated from the S&P 500. I mean, at the very, very least, separated between the S&P 500 and the Russell 2000, or, potentially more than that. And kind of go along with your slide of expectations of U.S. equities going forward, the next 10 years being 6.3%. This is going to sound like it's really typical broker speak here, but it's really not. I'll just tell you, I mean, if you guys are expecting 6.3% in U.S. equities over the next 10 years, it's not necessarily going to be the same as it has been on passive versus active. I mean, in a 6% return environment, active should be in a little better position to outperform than it has been in a positive 12% equity market, right? I mean, that would be the idea, I would hope, right?
Right, but if you look at what's happened in the indices, it's been very concentrated, right? It's been the top 7 stocks have driven most of the performance, especially in the large cap space,
So
right?
do we have some flexibility to separate these things out?
Absolutely,
certainly.
absolutely.
Different number of,
Absolutely. We could do an S&P, we could do a Russell 2500, the Russell 2000. That's not a problem at all. The thought here again was passive, low cost. We're going to put the equities to work. And again, when you start breaking apart that 13 million allocation to large cap or small cap, they become smaller. And so again, we're still trying to find that most cost effective way to get you that exposure, and then use those active dollars really for 3 things. One for opportunistic return in the private equity space, the real estate space, the GLI space, high yield, and then also those tend to be less efficient markets where you don't have those concentrated returns among the 7 names, and then also to play defense, particularly in fixed income. In the high yield space, you want active management there to prevent defaults in the portfolio. You want to play a little bit of defense. So that's the thought behind kind of the very cheap index exposure, and again, the size of the allocations as well, and where we want to put the most effective use of those active dollars. But we can certainly break it apart into S&P 500, Russell 2000. There's no problem to do that.
thanks Kathleen, sorry.
No, this is fantastic. Please continue with the questions. I think we want to be as responsive as possible, so as things come up, it's much better to ask along the way. But the last portion of your first question is really the steps. So if I can draw your attention to page 17, what is the steps to get this investment program off the ground? And we've outlined a very simple plan for you here. I want to highlight that if we were hired as your investment manager, we have a much more detailed spreadsheet with lots of assigned responsibilities. We tried to simplify this just for this purposes. If you were to award the contract in December, the first few weeks would be administrative, working with legal counsels at both Northern Trust and at the city, signing the contracts. What would be extremely important in your case would be creating that investment policy. You don't have an existing investment policy document, and your investment policy document is extraordinarily important to the success of this program. That process, designing that, I have done this dozens of times for other public entities. I'm very familiar with what should be in those documents, and Jim and I would come discuss all the components, the risks, the returns. That document would have detailed guidelines that we would then use when implementing your portfolio. We want a target to 10% high yield plus or minus 5%, for example. That would be that detailed. And those are the guidelines that we then have to implement your portfolio and manage it ongoing. We would get approval from the board. If there's city staff that wants to be involved, we could certainly come and meet with as many people as possible. Once the contracts are signed, once the investment policy is set, we would work with any sub-managers, any of the private investment managers that require their own documentation. We would work through, get all of that. But given the size of the portfolio, the initial implementation using mostly funds, once the custody accounts are set up, we can get these funds invested pretty quickly. Purchasing mutual funds could happen. You can put the orders in today and they'll settle the next day or the day after. So getting these dollars to work can be very efficient and will happen very quickly. The only ones that may take a little while are the private investments. You subscribe to those investments, and then it's the managers that will call those, and that could take a few quarters. But we will work with you to create a target, an investment vehicle for those funds to sit in as we wait for the capital to get called. And then annually, ongoing, we would always review the strategic asset allocation, make sure that it still makes sense, is appropriate, and ongoing every day, it's our responsibility to track where your portfolio is versus your goals, to make trades for those April disbursements, to make trades as you get your July contributions. So that process is ongoing and occurring daily. And with that, I will flip us to our second question, which is proposed, and we'll turn it over to Jim.
If I can just do a quick time check.
Yeah.
Yeah.
That's right.
So we've got about 15 minutes left, and I just want to make sure that, if these seem to be in chronological order to what's really important to you, so if you want us to just try to get through as much as possible in order, that's fine. If you've got topics that you want us to spend more time on in the last 15 minutes, we're happy to kind of navigate the conversation a little differently. So I just wanted to open it up to you guys.
Well, I'm interested in manager selection, but it sounds like it might be a little premature for us to talk about that at $52 million. So at the next,
Specifically about manager selection.
I'm just interested in your process of how you select the
Okay.
active managers.
Well, we can definitely hit on that.
But at $52 million, are we in more passive than active until we hit $100 million, or
No,
not
right now
necessarily?
it's 50/50 passive to active, and your question is very relevant because we have a number of active strategies while they're in the mutual fund format. They're managers that we're still vetting, reviewing, and making sure they're the right fit for our program. So your question is very applicable to the size of the portfolio today, is how we're going to look at managers. So if you want to spend a few minutes on
Yeah.
manager
Would
selection.
you guys like me to go there now?
Well, let's see if there's anything.
One of the things too is that I think we want to be fair to you guys. If there's a few things that are definitely highlights throughout these bullet points that you guys feel like are important that we need to know from a Northern Trust standpoint, maybe I wrote seal there on asking questions and maybe shouldn't have. But, if you guys want to go through what you want to go through here, and then we can kind of circle back to the questions that we have. I mean, if you want to go through quickly, just sort of what you guys think the highlights. I'm sorry, we've got.
Oh, that's okay.
No, that's fine.
What I want us to remember is we compare you to the
Yeah,
others.
that's for sure. I want to give you guys, make sure you guys have a chance to talk about that, because I've got some other questions on a couple of other things, but I'll wait till the end.
Make sure we
Well,
get
I
to
think
those.
we kind of hit
So
on the
then
team
we hit on
structure.
this- Yeah, exactly. Just real quickly, I think you've had a chance to meet Kathleen. I'm responsible for your total satisfaction. It's with our investment strategies, our performance results, and the ultimate delivery of our client service in your OCIO experience. I think you'll find, our team to be easy to work with, and we embody the things that are part of the Northern Trust 130-year legacy: trust, integrity, service, and expertise. And we're going to bring all of that to you. We're backed by 144 investment professionals that are going to Manager research is one of them. We got 49 people that work nothing but focus on manager research. And so you get all the resources of the Northern Trust. Kathleen was specifically selected for this assignment because of her background, because of her experience putting these trusts together. And so she and I will attend your meetings. We're also supported by Ty Howe, who's what we call an associate client investment officer. He helps out with the day-to-day trading, putting in the trades, making sure they settle cash movements, reporting and performance. And so you'll see his name. But there's an army of people behind us, legal compliance, portfolio manager research, portfolio construction that we lean on to deliver the results to you. You had a quick question about what happens in turnover. While Kathleen has signed a lifetime contract with us, we will allow her to go on vacation from time to time. But in the event, I can certainly step in because I'll be well versed in your strategy. We also have a team of 7 client investment officers that have 20 years average experience. We meet quarterly to go over all of our clients, and so we're all well versed in what's happening in each other's portfolio. So if there was a need to have any kind of transition, it's very seamlessly done because we're talking about the accounts all the time, and I have intimate knowledge of the portfolio.
So things we want you to know. I would go to slide 26 so I can briefly hit on value add. So some of these are kind of resounding themes that you probably heard us hit on in the first minutes that we've been with you. But our business exists to serve clients. And in order to retain clients, we've got a 93% client retention rate on our OCIO team. What are the things that we need to be doing right? We need to be delivering investment results first and foremost. That is what you are hiring us for. So the first column that you see on manager selection, that is part above portfolio construction and the allocations that we talked on, our ability to select managers. So Ann, this is an incredibly important comment that you had earlier, is really what drives performance for us. So there are a few snippets here on our OCIO composite. Comparatively speaking to peers, we're outperforming on a 3, 5, 7, and 10-year basis. That's our nonprofit foundation and endowment composite. So it has a more similar asset allocation to what we see suitable for your trust versus our retirement composite, which also has pretty good performance, but just not as relevant for you. And then as you look down further, we have some highlights on the 50 South Fund to Fund outperformance. It is outperforming the Cambridge Associates Private Equity Fund to Fund and Secondaries benchmark on a 3, 5, and 10-year basis at an average rate of about 450 basis points. So those are those fund to funds. Past performance not indicative of future results, we know that, but we've had a proven track record of having access to some really skilled managers. And then on the private equity, the custom accounts I had mentioned, a 24.6% return for the custom programs that are in our OCIO client portfolios. So that's more of a quantifiable metric. When you're thinking about evaluating providers, there are some other things that are really, they're kind of hard to quantify, but when you know, you know. It's chemistry, it's the ability to work really well together. We've had a number of successful onboards this year where the feedback from the client has been, yes, everybody I talk to can do this job. Everybody is big and has investment expertise, but we felt more like you. We saw ourselves working with you. You were very flexible. The way that you talk to us, explain things. Everybody's on the same playing field. As Jim mentioned before, nothing is going to happen without your prior knowledge, and our mantra is kind of like no surprises.
No surprises.
That's why we keep our clients happy. So being flexible, being able to bear those resources across the firm, as Jim mentioned, 140 folks, bring them to you. And then finally, operational efficiency. I mentioned the custodial services that we offer that make things a little bit more convenient and operationally sound, a lower risk of some operational event if we are your custodian, but again, we're agnostic. And we bring OCIO fee savings, and when we scale that $140 billion we put the pressure on those managers to give us better fees for our clients. We don't take any haircuts, we don't earn anything from that, it's just for the benefit of our clients. So that being said, I wanted to talk about manager research on slide 32. Do a quick time check here. Some things that are different about the way that we approach manager research versus how a traditional consultant might do that. First and foremost, our open architecture, we believe we have a duty to bring you the best ideas and then have a conversation. If that includes Northern, if it doesn't include Northern, we just want to bring you skilled investment managers and strategies. We've got a ton of experience and stability on the manager research team. We have specialized analysts in each asset class that have decent tenure around Northern Trust over 10 years. We've got 26 that are dedicated to alternatives. And we do a 360-degree view, which means that we're doing the investment analysis on performance on the team, on their strategy, the longevity of the investment metrics. But what we're also doing are the operational and compliance procedures. So for instance, is there a separation of duties between the investment compliance and trading and back office services and functions? Or are they running everything on an Excel file? You know, we go and we do very deep analysis. We look at their legal filings. We look at contracts. We want to know that these managers are going to be in business for the long run because we're placing client assets with them. So it's more than just the investment lens that we do. It's a very holistic view of manager research. One thing I want to mention is we fund on approval. So if you talk to a traditional consultant, which we're not, we haven't gone to market offering, traditional consulting services for the last 40 years. We are more of a practitioner in the marketplace, being accountable for the investment decisions that we make on behalf of clients. So for that reason, we don't have to come to you with 5 different options in an asset class, right? We come to you with the best option that we feel for that portfolio slice, if you will. So what that means is that once a manager has passed our due diligence process, we're placing assets with them. And this helps with our overhead, it helps with our business and how we run things. It's incredibly efficient, and we know our managers really well. So instead of a mile wide and an inch deep, we're an inch wide, a mile deep, about 260 strategies on our platform.
Yeah, it also enables us to, as we build critical mass with a manager, we can negotiate lower fees. And as Lindsay said, we pass that on to you. We don't step in the middle of that at all. That's all for the benefit of our clients.
And I'm happy to, investment philosophy is really about finding a consistent, repeatable investment strategy with a manager that can add value over time, right? That is the whole investment philosophy, and it's on a risk-adjusted basis. I have some stats on our, if you will, it's not necessarily a composite, but in the real asset space, we have 39 managers on a 3, 5, 10-year basis, 62% outperformance, 85% outperformance, 94% outperformance. For fixed income, we have 81 strategies, and they're all above 84% outperformance on those metrics. For international equities, we have 30 strategies, 70, 97, and 96% outperformance versus their benchmarks. So we are skilled in finding great managers for our clients. You had asked about sourcing. I would say we have an open door policy. That's first and foremost. For traditional asset classes, most of our managers we find on database searches, or they reach out to us, or we know them through our network at Northern Trust or with 50 South Capital. We have 700 manager meetings a year on the traditional asset class side. About 70% of those are with new managers, so we're always out in the marketplace trying to find the best managers available. And our alternatives team in 2022 met with 1,100 funds. From that, they did comprehensive due diligence on 56, and 37 of those managers got commitments for the latest private equity fund. So that's just some perspective on how we source, where we source, and how they end up passing our due diligence process. So we have a couple of minutes left. Are there any topics that I didn't cover that you guys are dying to hear about? I might just hit the proprietary product on, I can't read
I can
this.
tell you have a question, Rick.
Yeah, but I don't want to.
He always.
Yeah, go ahead.
No, go ahead, that's what we're here for.
So a couple things. One of the things was a pretty quick one, I think. You mentioned something about the custody and that there's separate. Explain to us. I don't think I understood what you meant by you can only custody it, or you could do this part, or you could just custody or something. I don't understand what you said.
Your
about custody.
search is for investment management services, right, for the OCIO, and that's what I gave you the pricing on. But as a benefit and a consideration, if you'd also like to partner with us for the custody of those assets, we would be happy to give you a discounted fee than our off-the-shelf custody fee. So it's a $65,000 minimum annual fee for custody.
All right. So, and when we're trying to figure out all of these costs that we have, you know, the internal and then the OCIO, and then we just need to add a line for custody. And I guess we can talk to Brad a little bit more on that. So on 65,000, will it stay 65,000 as we add more money, or does it go to a percentage at some point? What does that look like?
So that's the minimum annual fee, and it could differ depending on the types of accounts that are set up, but as we mentioned, these are a lot of funds, so typically they're low-cost investments. What else should we consider for custody? I can get you more specifics on that, but my advice would be that it would stay around that 65,000. It's if we're going into esoteric markets with separately managed accounts where things become expensive. And
Yeah,
that's
you'll
not
have a
what
lot
we're
of
looking
single
to
line item because of the use of the mutual funds for a while until this portfolio grows. You'll have some of the alternatives, which, you could have, again, it'll take a little bit of time for that part of the portfolio to grow. The advantage here is it's an enterprise-wide solution, and that really brings about efficiencies in terms of cost, in terms of straight-through processing, trading, in terms of getting reporting. We can see the portfolio easily. We work with, again, we are custodian agnostic. We work with roughly a dozen or so custodians. About 70% of our clients do use Northern Trust for custody. Again, not as a commercial, it's just a fact of the matter. It's just easier, more efficient. We think there's less risk in that as well, but we'll work with any custodian that you may have. And again, we're able to offer some fee savings on the custody side of the assets as well.
So the alternative to that is we keep the money in a bank account here, and then whenever you need, when there's capital calls or trades, there has to be transfers from the bank to...
Exactly. And so, and again, wherever the assets are currently in custody or held, you could give us some delegated rights then to, begin to open accounts and, fund these managers. And then, as you need money, we would raise the money. It would be there available for you, working with your current custodian. So that's the other arrangement. And again, we'll agree on, what authorities we would have with respect, and you would grant authority to the custodian. Because again, the idea is to kind of take these activities off your desk, put them on our desk, so that you don't have, you're freed up then to, do the work of the community and figure out what the best use of the funds are.
Does that simplify things with regard to cybersecurity issues or audit, or are there other benefits?
I think there are, because we're obviously familiar with our own processes and procedures as we are, with other custodians. But again, I can speak more strongly about the cybersecurity steps that, the Northern Trust takes versus the dozen other custodians that we take. There's always, and anytime you're transmitting data kind of outside the organization, there's always risk, right? Unfortunately, in the environment that we're in today. So
I think we're one of the top 3 largest custodians.
Yeah.
And we take that extremely seriously. So when you bring up cybersecurity, I know that at the organizational level, we spend about $1 billion a year on technology, on enhancing the platform that we already have, and cybersecurity is a huge component of that. So just as you analyze what services you need, and if you're thinking about using a different bank or a different custodian, that's fine, but just understanding what support and resources that entity has to keep your client capital protected is important.
Kathleen, I appreciate all your experience with public entities. So have you seen other municipalities sell utilities like this? Is this a common thing?
It is not terribly common, but I have worked with another entity that did this exact same thing. They were a tech college in Wisconsin. They ran the local PBS channel, and they had unused airwaves. So they went through an FCC Spectrum Trust, sold those assets at auction, In fact, actually, I worked with 2 community colleges that did this, but one of them went to the state, created a trust for the very first time, which was a really unusual process because generally in public fund investing, you're talking treasuries, agencies, safety, liquidity, and yield. That's the most important thing when it comes to public taxpayer-funded dollars. So to create a program that considered alternatives, to consider stocks was very unique. It was brand new for them. So we walked through every step talking about all the asset classes. In my career experience, I have only seen it happen maybe 10 times or so. Public entities, cities, it is challenging to do the work that they do. They might not have a retirement home. I did work with a county once who sold a retirement home to fund some of their businesses. These types of ancillary assets, to be able to sell them and create a long-term program is a pretty rare benefit and a really wonderful opportunity the city has.
Yeah, there's one pending now, I think in Ohio, a pending sale of a railroad that'll bring some monies back to the community for, reinvestment in community purposes. It's not 2024, I think it's supposed to be finalized.
So we may see more, I guess.
So we may see more types of these sales, yeah.
It's pretty rare. I think public entities are getting very creative in trying to fund the important missions that they serve. They are very important. They serve many residents, and I think the cost of operating cities and local governments is increasing so high, they have to really consider these other options.
Especially when you live somewhere like Rutherford County where the growth has just been exponential for decades.
Oh, sure.
That's awesome. I know we're running low on time, but for just a quick 1 or 2 minute answer on just the client engagement piece of this.
Sure.
Which kind of means us engagement. Somebody made a mention about attending meetings or something like that at one point, but just to give us a really broad idea of kind of what this would typically look like, and like I said, a quick answer on just what this sort of typically looks like. We meet every month or 2 right now, and don't know how, we'll probably meet every quarter, but that doesn't necessarily mean we need a full-on, you guys come in and do a big, whatever performance and break down all this every quarter. But what does it typically look like in relation to getting this thing started and then the ongoing kind of management or maintenance or whatever you want, client service, whatever?
Sure. So our client service model, I think, boils down to 2 words, and that's no surprises, right? There should be nothing that happens in this portfolio that you don't know about. And so client engagement really runs the gamut from kind of ongoing, very informal, which are the phone calls, the emails, especially up front, but we're trying to get paperwork done and we're trying to get accounts established. There's a lot of interaction there. That's almost daily until we get this thing set up. And then in terms of actually, we will have continued emails and phone calls about, hey, market events, or, we've had a couple of rough things, or maybe, maybe the Fed's done, maybe we ought to think about this. But as we go forward, the more formal are the quarterly meetings, or whatever cadence you decide is right for the committee, that we would come in and give a formal report of the actions we've taken, the performance of the assets, what our thoughts on the markets are in a book format, if you want, however you want it done. But there's certainly always the opportunity. It's really customized. It's really what you want. Sometimes I say it's almost like dating. You're trying to figure out, how much am I supposed to call, or how much do they want me to call, and you're trying to, to get that. But it's really customized. We have clients that we send a report to weekly. I have another client that I probably talk to 2 or 3 times a week, and then we have ones that just say, come to the, bring us your results to the quarterly meeting. And so I think the most optimum is somewhere in between all of that. But the idea is to make sure exactly what's going on in the portfolio. And so we'll find that right balance, with you. If you want a monthly snapshot, we can certainly do that. If you want a weekly recap, we can certainly do that. And then, once a year, we're going to take a look at the IPS, make sure it's still consistent with the objectives of the portfolio. We're going to ask you how we're doing. And we're okay with blunt feedback. We've got pretty thick skin, we're okay with that. We want to make sure we're always exceeding your expectations. And then every 3 years, we're going to do a full-blown, we'll do what we call an asset liability study to make sure the asset allocation is in line, the funding policy is still what it needs to be. And so there's a lot of built-in checks and balances on the system as well. The other thing I wanted to make sure we mentioned is that everything that goes on in the portfolio is overseen by our investment oversight committee, and I'm a voting member of that. So clients, allocations, performance, the managers we use, the managers that get hired, the managers get terminated, all go through our investment oversight committee, and that meets twice a month to make decisions. And so there's a very strong, robust internal process of systems and controls to bring about stronger fiduciary governance, which is good for all of us. So I hope that answered your question.
Absolutely.
If I may, just have 1 minute, just to close out, if that's okay? So on slide 46, thank you for being so generous with your time. Thank you for all of your questions. We appreciate that. If anything has not been answered today, please don't hesitate to reach out. We know this is quite the formal process, but we're very easy to coordinate with. We're here to answer your questions. This is a big decision. We want you guys to make the right one. We want you to partner with us, but we want you to have all that information to make an informed decision. And as you think about today's meetings and who you want to work with, the 3 things that I want to leave you with about Northern Trust: number 1, why do you want to partner with us? A higher probability of investment success. That comes from our track record of running institutional dollars in an accountable way. We have the performance to back it up. We've got the skill set on the manager research team. And again, that track record of working with a practitioner that has a risk-managed growth philosophy is really important, especially if you have a conservative-like portfolio. Exceptional client service. Kathleen has 2 other clients. We hope to get her more clients, but our client-to-advisor ratio is 7-to-1, generally speaking, on the team. So that is something that you can't really put a price on when it comes to the level of support that you need, her accessibility. Yes, we work out of the Chicago office here, but just because she's not in Tennessee doesn't mean she's not happy to come down at any point and have these meetings, to be in person and to help you with your mission. And last but not least, we are a stable and responsible steward of our own assets on the balance sheet, but as well as our client assets. So as Mike mentioned, we've been in the business for 140 years as an organization. We have a reputation that precedes us about being financially conservative and stable, hence the Moody's rating recently, amongst some challenges for banks in the regional space. We are committed to this OCIO business. It is one of the facets of asset management that is growing a lot, and we have senior leadership invested in making sure that our team has the resources to continue to give that excellent client service. That means, a multi-million-dollar, multi-year plan for infrastructure that we have integrated this year going forward to enhance the reporting structure that we have, just to make sure we have the best output, the best reports, the best CIOs on our team that we can have. I can tell you that our new president, who joined in April, is very invested in the OCIO business. And last but not least, our aligned values. We see the very important work that you want to do here, what your mission is, and as an organization, we feel that we're aligned with the way that we our philanthropic footprint in the communities that we operate and we serve, and we know how important that is. So you're getting the expertise, the experience, you're getting great client service, and you're working with a partner that has aligned values for your mission. I think that's a pretty good partner, but I'll let you decide. But thank you for your consideration, and please let us know if you have any additional questions.
Thank you.
Please extend that to Kevin and Lee as well, 'cause they may have questions.
Brad, do you have any
Great.
questions?
Thank you very much.
Thank you all for your time.
Really appreciate it.
Right now that we're done, can I lobby a softball? Sure. 8 months at your previous employer, 8 years at previous employer, 9 months at this one. What excited you about Northern Trust? You could have gone anywhere.
It's such a great organization. The people that work at Northern work there for decades. They work there for so long. If you go to an organization and everyone on your team has been there for 25, 30 years, that says a lot about the quality of work experience you have. It's such a friendly, exciting place to work, and my colleagues are fantastic. If you met these individuals, you'd absolutely want to work with them.
So Northern Trust, we employ more than 20,000 folks, and we have a quarter century club. Folks that have been around at Northern for more than 25 years, and that club consists of more than 1,000 people.
Excellent.
And when you said softball, Kathleen played softball for Yale, so I thought you knew that somehow, and I was like, oh no, you just...
My sleuthing didn't uncover that.
And you're right, she could have gone anywhere, and we were very fortunate that she chose us. So as much as we wanted her to come, we were very fortunate that she chose us and brought all her expertise. We're thrilled to have her.
Again, lifetime contract.
Yeah, in there. Yeah.
looks like we got should open up, there'll be a Rolex inside of it.
I don't know real well. It's in my safe at home.
Don't get it out much.
Shit out of that face. 'Cause I'm such a doorways. I'm always putting the bucks in and buff and clean it and all that stuff.
Yeah.
Well, I don't even wear a watch. I used to have an Apple Watch, and I got annoyed by the volume of pings I got out of that thing.
Yeah. I can't do it. I don't like it on my phone. I'm not going to.
I think your children will.
Yeah.
Let's get in mine.
So good to meet you.
So nice to meet you. Thank you.
And thanks so much for your time, really appreciate it. Thank you very much. Oh, you're very welcome. Pleasure, man. Thanks for your time.
60 minutes.
Thank you so much, really appreciate it.
Take your back.
And we're, as much as I'm a suffering Bears fan, we are thrilled to have Darnell Wright from Tennessee. He gives us hope for the future. We still have a long way to go.
We
But
had a big divisional win Monday, so we
ugly, but we'll take it.
Y'all need those southern boys.
They do.
Yeah.
Those southern.
Speedsters.
He's got a lot of fans in Chicago very quickly.
Good.
So,
Nice to meet you.
Appreciate it very much. Thank you.
Sir, well, how are you?
Doing well, thank you.
You're just
Hey, Sean, how you doing?
I'm glad you made it today. We needed the numbers. And one of those good questions. I'm not smart enough to ask good questions.
Glad to be here.
I have questions, but I usually just try to listen to hope that I get the answer.
I was going to say, yeah, way over half my questions are answered if just by listening. It comes up one way or the other.
Yeah, but it was good. I mean, having that tear sheet, everything kind of flowed. Because there's a lot of information, especially when it's three different companies and three different board books. So,
Thank you so much.
All right, see ya.
Oh,
did you have a good Thanksgiving?
I did, I hope you did.
Did you have, is your family around here, or did
Pretty
they come
much,
in?
pretty
or-
much. I've got, let's see, I have 4 grandchildren, 5th one on the way. And my daughter lives here in Murfreesboro, a son in Franklin, a son in Brookwood, so now we're
Okay, so very good.
we were all together, and it was a nice day, relaxed, plenty to eat, just good. One of the best ones we've ever
Brad, what
had.
time is our next one start?
Pretty good. It's more about
Take a break now. 1
the
minute.
fact that your family's safe and they're together and hear people laugh.
They always run a little long, that's why I gave a 15-minute window.
Tell me something on this custody deal, okay? 'Cause this is process.
Yeah.
The little
This
things
is
get more
not
important.
normal in my,
Yeah.
come to Raymond James.
Yeah.
Yeah, I mean, it's just all part of the deal, right?
The oldest was 5, and 4 of them, so they're all young.
That starts, they've got,
It's a lot of fun.
So that 5-year-old starting school.
Well, look, at the end of the day, whether you're managing my $1 million or
Obviously, in order to trust, you gotta say on the trust, right? Yeah. Which I
that
don't
number
know.
was very high, it should be 3 to 4 basis points.
That was like 12.
I know,
previous business.
Yeah, I mean, that was,
Well,
If I have to get
but I thought, I was like, oh, God, that's a big level of cost that added to this thing.
that's scary.
15 and it's sophomore PCA.
I mean, I can do, I mean, we can get individual private equity sleeves, I mean, we're putting,
Yeah, I played Franklin Road, and then I went to a small college in Wisconsin. It was Division III. And I played football and basketball for 4 years.
oh, Franklin.
Here in Murfreesboro.
Oh, in Murfreesboro, I thought,
I'm sorry.
7.
Yeah, no, there's like, Christian Murfreesboro, there's FRA, then there's Franklin.
Yeah.
And then there's Franklin Classical School. So there's a lot of Franklin. Several of them. Yeah. All right. So I graduated in 94.
Okay. Well, I'm a dinosaur. I played basketball at Lipscomb University.
Then it makes that.
Were they NAIA at that time?
We were. We played union
Okay.
every year.
Yeah.
Played union every year. It's great.
Yeah, yeah.
I was actually recruited to go. It was
just ask her that one more question.
High
and then
school,
he's-
second graduating class of
Oh, should have kept my mouth shut, because she was in the middle of her thing, you know, but anyway, I guess it all works out the way it's supposed to.
All right.
You have a lot of questions, my man. Why don't you just start off first? I have my first 10 questions right here.
It's
But
a
you're right
curse.
to ask about the money.
It's a curse, man, I'm telling you, it's a curse. I gave it to my son, too.
Quite a player.
It was a commercial play.
Yeah.
And of course, having since then, somebody told me that president from 97 to 2000. We don't charge any
I think ours uses SEC.
understanding recruiting
I think our
budgets and so
custodian.
forth. It was a big deal back then.
So you must have been a big target. Yeah. In Jackson, there were
Okay.
options, especially today.
It's the first time I've ever been on there. That's pretty good. That's pretty good.
Always 1 hour, you know this.
Percentage.
Hour and 15.
Walked out, that was more than an hour.
That's a great.
You got 15 minutes with them.
You're gonna be next to me, so you can like.
Make sure you're not flipping this off ESPN or something like that.
Out there now has been very.
Assume I have my computer up.
Except they're doing it as a percentage of, you know what I mean?
Everyone has electronic versions, but some people may want hard copies.
Yeah, I'll pass them out, it doesn't hurt.
I'll walk around.
Are they charging us a
Right now with our banks and different things to where if the judges come in and say, we can't.
Oh, okay, all right, great.
I want to hear that.
The trustees.
Yeah.
Chemicals charging
No,
us.
you're right. Yeah.
And being true.
Hey, how's it going? Watch out.
It's sticky. Charles, Richard Stone, good to see you.
Careful. Get all of the snake get you, or you got Rick. Get you too. All right.
Your son has a
Well, I've
great.
got my notes in mine, so.
Sean Apple.
Steve Fleck. Yes. Brad, I know we've
Seen each other virtually, but it's nice to meet you in person.
Yeah, absolutely. Boston?
Hey,
I'm Steve Charlie.
I'm not going to shake your hand.
No worries. The plane. I'd have to, I don't know if they would, oh, it's not a lot of it is that.
My wife and I got married right after college and
Oh, nice.
raised a family here.
No, save a tree.
I got cousins.
You should get sit, see, go a lot, baby.
Yes.
For parts Tennessee.
That's exactly right. You can say that about any state that you live.
Honorary captain.
Just everybody real quick.
Are y'all ready to get rolling?
Yes.
All right, I'll start the introduction. You guys know me, Brad Alford, Apple Capital. We'll go this way.
Craig Tyndall, city manager and staff for these guys, administration.
I'm Ann Davis, and I'm the president of the Christie Houston Foundation here in Murfreesboro, and we're a private health legacy foundation.
Richard Stone, market president for Capstar Bank here in the Nashville area.
Good morning, Sean Applegate, Chief Legal Officer at Venture Express. We're a trucking and transportation company headquartered here in Murfreesboro, Tennessee.
I'm Rick LaLance. I'm a former city council person for Murfreesboro and Raymond James advisor here in town.
I'm Steve Flatt. I'm the CEO of NHC, National Healthcare Corporation, headquartered here in Murfreesboro. We're a publicly traded senior care company.
And we have a couple other trustees that aren't with us. We have Kevin Gentry, who heads up administration for the state's trust, investment pools. And then Lee Moss, who's retired bank president, who's out. Don't anticipate them being here. Kevin might come later. He had meetings, so see if he slips in. Thanks, our board.
All right, you ready to take off?
Great.
All yours.
Great. So I just confirmed with Brad that we've got about an hour, maybe a little bit of wiggle room in there, so we'll definitely focus our comments along those lines. Brad has also given us some questions that he wants us to address throughout the presentation and discussion. What we thought we would do is, as we get to certain points in the conversation, we'll point those out to you, and actually they're kind of listed at the bottom of the pages where they're really relevant. And if that's all right with you, we won't jump around because it gets a little disjointed when we just try to go through the questions. And if we told you, for example, on the first question, it was, what does your portfolio look like, without any context, it's hard to talk about your portfolio. So as we're going through, we'll point out all those questions and make sure we have it right. So let's do introductions, and then we're going to start off with Ryan here.
All right, well, thank you very much and good morning. My name is Ryan Walter. Before I get into a little bit about myself, I just want to take the time and wish you well in your search. We know it's a lot of work, it's a big time commitment, and we hope that you find the ideal partner for your community. As I stated, my name is Ryan Walter. I am a senior consultant with NEPC. I've been in this business for 18 years, so one of my clients says I'm an adult now. But I've been working specifically with community foundations and nonprofits like yourself for the last 10 years. I did recently move over to NEPC about 2 years ago. There's a plethora of reasons of why I did that, but most importantly, I moved to NEPC based on what we can do for our clients. So I hope that we're able to communicate that. It was a big decision on my part, but ultimately I felt like I could serve my clients better with NEPC behind me. So I have the great privilege to be able to specialize in, I work with community foundations, but also endowments and foundations. Really the commonality with my clients are that there's a charitable focus, nonprofit, tax exempt. So another good example, in addition to some community foundations that I work with, would be a public university where our work is made available to the public and out there in the public domain. So we are very accustomed to that spotlight and the responsibility that comes with it. Lastly, before I hand it to my colleague, very exciting to see, the projected growth of the trust here. And when I look at my own projections, I can tell you, I think based on my kids, that I'll still be here in 2035 working, and most likely well beyond that. So thank you for this opportunity to, compete for your business and trust, and I'll go ahead and hand it over to Scott.
Thanks, Ryan. So I'm Scott Perry. I would effectively be your portfolio manager, managing the investment side of the equation here, and working with both Ryan as well as the board, and really customizing a portfolio for the trust. Prior to running the OCIO investment team where I am today, I spent 10 years, at the end of that time, heading up our charitable investment team, and I've been working with very similar institutions, similarly sized, similarly positioned as far as the mission and goals that they're trying to achieve. So have a lot of familiarity with your types of organizations. And then on a personal note, I'm involved in a number of local nonprofits, so I appreciate the mission and the service to the community, and would love to partner with you in supporting the mission.
Bless you.
Steve, I'll flip it back to you.
Great, thanks. So just a little bit of intro for me. So I'm going to play two roles here today. One is to give you some sense of the organization. I've been at NEPC now for 27 years, run various parts of the business, and I was happy to hand off the OCIO business to Scott, the OCIO being Outsourced Chief Investment Officer. When we use that term, I just want to make sure we're all familiar with the terms. So I started that business a long time ago, and prior to that, I ran different parts of the organization. And if you dig hard enough, you figure out that my dad actually started the company. So fortunate in that sense, but we'll talk a little bit about that and how that culture permeated the organization and where it stands today, because it's not a family business. It's a group of partners that kind of all work in the same direction. But the second part of my job is to make sure that we're meeting your objectives, and probably more importantly, exceeding your objectives. So I do play an ongoing role. It wouldn't be to be at your meetings, but it's to check in with the appropriate people to make sure that we are meeting everything that you've outlined as your goals and objectives, and if you need additional resources, that's a big part of my job, is making sure that we're doing that. And we don't expect that. Most of the time, it's a pat on the back, Steve, you did a really great job, but every once in a while, we want to make sure that we address any issues that you might have. So there is an ongoing role that I'll play in terms of making sure your relationship is all the things that you thought it would be. I'm actually going to get into the presentation here. So on the second page here, I think it's page 2. I can't see it, but it's tough when you can't see without your glasses. Just on page 2, yes, you see the team there. The team comes with a lot of people that support that team. And I'll focus just briefly on all the other resources that come with running an OCIO portfolio. And it's a portfolio manager. Yes, it's your team that you'll see every day, but there are a lot of people behind that, right? And I think this is one of the big advantages of working with NEPC, in the sense that we're a larger organization. You probably have heard that we run a lot of assets, yes, but when it comes to running those assets, you've got to have the resources and that scale to provide the real benefits to an OCIO portfolio. So over 70 people in our research team that are identifying really great ideas that will end up in your portfolio. A dedicated OCIO team and operations team, which we'll talk more about, but that team is very focused on running our portfolios and getting great ideas into your portfolio consistent with your objectives, not our objectives, right? So a really customized portfolio, and Scott will talk a lot more about that. So those talents are not lost on our clients, and one of the things that I think you'll start to hear as we go through this is that, yes, we're a bigger organization, but we're going to feel really small to you. So I'll touch on that in a few minutes, but we want to make sure that you feel like your biggest and most important client, and that's a true hallmark of who NEPC is. So let me just hit on page 3 here. Yes, 420 clients, lots of numbers on this page. Let me help you understand why that's important. Halfway down the page, I talked a little bit about, or referenced a little bit about the culture of who we are and how the organization is set up today. You can see about just shy of 50 partners in the company. No partner owns more than 6% of the organization. So I told you my dad started the company. He gave it away. And that actually is really important in terms of how we operate as an organization and the folks that we're able to attract to our organization. So Ryan is a great example of that. We want to be able to attract the most talented people in our industry. And there's only one way to do that. It's being an organization that offers the opportunity to be an owner in the organization and to put our clients first. And that's been a hallmark of ours for forever. It also has to do with how we run the organization. One of the things that you probably saw in the RFP is that we have a very low client to consultant ratio. So when Ryan looks at us and says, hey, you know what, I want to come to NEPC because NEPC thinks about clients first, and they're going to give me the time to spend with you to make sure we're building the right portfolio. So Ryan's not going to have 15 clients. He's going to have 6 or 7, which gives him the time to really spend with you. And, you probably, we did a little research on yes, we listened to your minutes, we listened to all that stuff, and you would expect us to do that. One of the questions that you logically have is, why is our fee higher? Well, our fee is higher, which allows us to actually dedicate time and energy and resources to working with you instead of saying every one of our portfolios are going to look exactly the same. We're going to not create a custom portfolio. We're going to actually have the time to spend with you to create the right portfolio, work with you through the governance questions that you have, and ultimately build a portfolio that's for, I'm going to use MCIT, is that okay? Or the trust, MCIT, right? So that's really key to who we are and how we build portfolios, and that's a hallmark of who NEPC is. Let me go to the next page just real quick. We did. One of the things that you heard in our introductions is that we think of you as a charitable organization. We also recognize that you are a public institution, and you have got a public board. All of this stuff is publicly available. You're in the spotlight in some ways, right? And yes, we work with a lot of big public funds, take that experience and say, hey, you know what, how do I apply that in the framework of a charitable organization that's, $100 to $200 million? That's where you ultimately be. We work with 160 charitable organizations that look everything like you. They're about your size. The vast majority of charitable organizations are around your size. That's our client base on the charitable side. So we want to take what we know from the public perspective and apply that in the charitable perspective. I don't think anybody else is going to be able to come in and tell you they can do that. We have that experience, and being able to bring that together with that kind of power is really important to ultimately who you work with, and being able to navigate the spotlight that you're in while still meeting and exceeding the demands of the charities that you're going to be giving money to. The last thing I want to hit on is just this idea of feel small, which I already hit on a lot, but be really big. There is, I'm sure Brad has talked about this, there are big advantages to being large, especially in the OCIO business. Having significant assets drives down your cost. Not our cost, your cost. And that's how we think about the OCIO business, really being able to take that and say, hey, at $80+ billion that we work with on the OCIO side, how does that benefit our clients? We can negotiate really low, much lower fees, and having that scale, and we'll hit on this more, that has a big impact at the end of the day on what the cost of your program is. Yes, we're going to use active and passive, all the things that you want to talk about, but if we're able to drive down those costs, those are additional dollars that you can give back to the community. So we want to look at that and say, hey, you know what, let's be aligned with our clients and making sure that we're offering those true benefits through our OCIO platform and driving down costs. That's the be big part. Yes, the resources, but feel really small. Having only 6 or 7 clients for Ryan so that he can work with you every day. So that's a really powerful combination. Some people look at it and say, hey, that's a disadvantage. I say, no, that's a really powerful combination that you'll ultimately benefit from. So maybe I'll take a pause there. I hit on a lot of things. Any questions on the organization that you might have that I can address before I turn it over and we can talk more about the portfolio itself? Great. All right, Ryan, you're up.
All right, thanks, Steve. So, our goal over my next few comments are to give you a good sense of what it would be like to work with NEPC. So we hope the next few pages, along with our comments, kind of paint that picture clearly. So if you're following along in the book, it's on page 7. But, we ultimately want to put ourselves in your shoes. Like, what would you ask us? And we think the answer to that question is, how is NEPC going to help us oversee the assets that are entrusted to the trustees for the benefit of the community? And our response to that is that, we're going to work to partner with you in order to be your trusted advisor or your trusted expert. What is that going to look like? There's a lot of work that would be done to set the foundation before we start talking about what the portfolio is going to look like. Examples of that in our process, or a few of the initial steps, we do offer to our clients an anonymous, what we call committee survey. I like to say that there's committees and trustees for a reason, right? You all bring good ideas, but you'll probably most likely have a lot of different ideas. So what we do and what we offer is a survey. It can be anonymous, but we essentially want to capture your thoughts as far as what's working, what's important, what should we most likely focus on, what are the goals and objectives. We will collect responses and then report them back anonymously of, here's collectively how the trustees feel. And we're going to talk about that. We can have a conversation about that. The end result of that is hopefully getting everybody around this table rowing in unison in the same direction. Information that we receive from there would work its way into a formal investment policy, which again is the foundation to help oversee these assets. We have a lot of experience. Gosh, me personally, I've read hundreds and hundreds of investment policy statements. So we can help draft it, we can help review it, edit, provide comments, whatever specific support that you need from us. But we think an effective investment policy statement is the foundation to ensure success going forward. So some of those aspects within an investment policy statement, or IPS as it's known, really quantifying, defining what the goals and objectives are. Knowing what the roles and responsibilities are of the trustees, of the consultants, as well as other service providers. Providing an asset allocation framework, providing liquidity constraints as well as other constraints. Also, how do we measure success? What does success look like compared to a benchmark or what have you? So the investment policy statement, I think, is an immediate value add that we'll bring and can shepherd you through that process, because there's a lot to think about, and that is essentially your document. You know, if there's a new trustee that comes in, you can say, here's our investment policy statement, here's what we do here. So we think that that's very powerful. In addition to, I'll call it kind of the governance documents, and we realize that there's a trust document as well as some state guidelines that are already being followed, but we obviously understand that there's a need for an investment policy statement, so we stand ready to help you with that. Also, just understanding, you know, the marketplace. That can be best practices, as Steve mentioned, kind of what similar clients that may look like you, have a charitable community focus, are doing, and we share those best practices with you. I'll name some other topics that we like, but before that we like to talk about. But before I do so, I think it's also important to note that Steve mentioned OCIO, Outsourced Chief Investment Officer, synonymous with discretionary advisor, which we understand is the service model that you're looking for. Even within the OCIO discretionary model, that IPS still belongs to you. Like that's your decision. You sign off on it, and then we work within that framework, and we have to adhere to that IPS. So that is your document. Obviously, we can help you with it. So on page 7 here, what the ultimate goal is, we want to get into a great cadence of reviewing these governance and fiduciary topics. So just to name a couple, being diligent about fees, understanding liquidity, educating you, the trustee, in order to make informed decisions and ensure proper oversight. So a lot of our clients, I'm thinking of a community foundation that I work with in the area, we create a formal work plan or a work calendar. And yes, we can add some ad hoc things to it, but it ensures that we're reviewing what we should be reviewing on an ongoing basis, again, to ensure that effective oversight and monitoring. So any questions kind of on the governance topics, leading up to the fund investment decision making? Before I hand it over to Scott, who will touch on our OCIO practice in specifics, and again, in the spirit of helping you understand what it would be like to work with us, more so on the portfolio side, you'll see on the next page, on page 8, I think this boils down to communication. A lot of my job duties and responsibilities are communicating what our firm is doing, simply being because you trusted us with these assets and have given and would be giving us discretionary authority to make investment decisions. So my job is to communicate what we're doing and why we're doing it, answering questions, and oftentimes just getting you comfortable with what we're doing and why we're doing it. So you'll see some topics here on page 8. Strategic insights, I'm not going to call out all these, but maybe just a few. Essentially, we're going to do the heavy lifting for you. We're going to provide the analysis that you need in a concise, easily digestible format. Again, going back to communication. So topics would include our asset allocation assumptions, our capital market assumptions, our return assumptions, things that get baked into our process, as well as how we construct portfolios and how we ultimately select managers. So Current opportunities, we're not market timers. We don't want to give you that impression, but we are constantly going to be scouring the investment universe looking for compelling investment opportunities. Couple popular topics these days are really the two in green, the active versus passive debate here on page 8. We will definitely be passive, and we're healthy skeptics on active management. We'll be passive where we think markets are efficient and where we don't believe that active management can add value. But there are some areas where either you can't be passive, there's no index for it, or we think active management can add value. I think a topic, again, if we were in your shoes, that we would be asking about is on alternatives. Your assets are growing. They will be growing. Portfolios like yours keep looking more and more to private markets. So what does that look like? We would shepherd you through that process, which I know Scott will talk about as well, and hopefully I'll get some more airtime and can jump in there as well, because there's a lot of communication and education that's needed around that. So shepherding our clients, through a very difficult to navigate environment of private markets and ensuring that we do it in a thoughtful way. So last comment before I hand it to Scott, really tracking your goals as well. So we'll talk about your goals if it's, I know it can be a lightning rod issue, but a lot of foundations have ESG, DEI related goals. Again, diligent on fees, diligent on liquidity, and we'll also create, call it a dashboard or a scorecard, so that we can track our progress there. And you can see that, right in front of you. I like to kind of call it like an x-ray of the portfolio, like, what are we doing here, and what effect does it have, and ultimately what impact does it have on your community? So
Maybe I'll ask a question. We don't think this is the case, but are there any diversity, equity, and inclusion or ESG goals that you have at this point, or maybe we should think about as we're talking? Okay, great. We didn't think so, but we just want to make sure we address those if those are items that you want to hit.
Thank you. Scott?
So I can, maybe before we pick up the page, or change the page, I'll just hit on one question here that was amongst I think the 10 or so that you shared with us, and you'll notice at the bottom of some of these pages, we've kind of referenced back there, and one of them was around, in what circumstances would you change asset allocation? And I think the answer to that is really twofold. One is when an organization's risk profile changes. Typically, their cash flows, maybe their revenues coming in or down, maybe their flows going out or have increased, or that the market environment has changed. So as a result, our asset allocation assumptions have changed. And I think there's a really good example of that in just the past couple of years, right? So for a long time, fixed income has had incredibly low yields and played a very kind of modest part of investment portfolios. Rates are a lot higher today. And as a result, fixed income is much more relevant. And the ability to earn returns from fixed income, much more relevant part of the portfolio. So those two things we think can be catalysts for change in asset allocation with client portfolios. And for some of our organizations, both of those things hit last year. And so I'll give you a quick example of another OCO client that we work with. And so they're a $70 million organization, charitable organization in Florida. They serve the Southwest Florida community. Their revenues are tied to the college football playoffs. And so as a result, there's a lot of change going on in the college football playoffs. It's hard to keep track of who's in what conference. It's hard to keep track of all the bowl games. And as a result, there's uncertainty that they feel about their revenue, and as a result, their organization and their cash flows. And then you have that market environment changing, where we think, in NEPC's view, that there's the opportunity to earn 5, 6, 7% in pretty good quality fixed income investments. And so when we're having that conversation, and we had that about 6 months ago, and we're doing a lot of the asset allocation work with this group, we came to the conclusion that we had the opportunity to shift from what was a more equity-centric portfolio to more fixed income and still deliver what we think will be similar returns with a lower risk profile. So I think that's a good example of when we might come to a point where changes in asset allocation might make sense for a certain organization when those types of things take place. So just wanted to flag that as a kind of live example of response to that question. I'm going to shift gears now to talking a little bit about our outsourced chief investment officer team and our business, and that's on page 10. So Steve has foreshadowed this a little bit in starting the business here 13 years ago. So we've developed a pretty good track record that we can point to at this point, something that we're certainly proud of. And a few of the key numbers on the page here are that we work with over 90 clients, represents close to 230 different pools of assets that we work with. And hitting on that leverage point, perhaps the most important number on the page is the $83 billion, because the $83 billion gives us that leverage to negotiate the fees on your behalf and push them lower. And we'll show you kind of tangibly what that means as far as your portfolio potentially. We highlight that we've got 34 folks dedicated to OCIO investment, OCIO operations, and legal. And we're part of a bigger 71-person research team. And that research team is asset allocation people and tools. It's portfolio construction. So that means how do the pieces all fit together in the portfolio? And it's manager research, identifying the best investment opportunities out there in the marketplace and having people across the different asset classes that can do that. So those are the resources that we're trying to bring to bear for you and reflect in the portfolio. And then all of this is overseen by the OCIO committee. And so that's in the top right. That's a group of senior people at the firm, Steve included. And their charge is really to ensure that the goals and objectives that you've laid out in your role as the board are reflected in your portfolio. And they're regularly reviewing those to make sure that we're in line there. So I think that's really important to understand, is you have that oversight function that exists within an EPC to make sure that we're on the ball and doing things the right way. So that's a little bit about the OCIO business. And I think, again, why it's important is because I think we've developed an experience and we've developed an expertise that we can bring to bear for the trust. The next couple of pages just get into investment beliefs and philosophy. And so, in developing a portfolio for the trust, what you'd likely see is many of these themes prevalent in the portfolio. For example, the first one is developing a customized portfolio for you. You have unique cash flows in that you're going to be positive cash flow all the way out until 2035. And so that puts you in a little bit of a different position versus many other charitable organizations. And what that means is a model portfolio doesn't work. A customized portfolio that reflects that makes more sense. Another one is global diversification as a starting point. That is for us where we start. Global opportunity set, and then figure out what makes sense for the trust. Should we have more U.S. assets versus non-U.S. assets? Should we have more stocks versus bonds? Figuring out all those different levers that we can pull to create the portfolio that makes the most sense for you. Next one, which is number 6 on the page, is illiquidity premium. And we're going to get to this when we talk a little bit more about a prospective portfolio for you. We believe in the illiquidity premium. We believe that investors that have a long-term time horizon and the ability to take on illiquidity can benefit in the form of higher returns. And so that's something that we'd spend a lot of time on. And as Ryan said, a big part of that is education. Know what we're getting into before we commit to that and put that in an investment policy statement with you. And then the last thing is just knowing kind of how we operate and what you can expect from us, which is measured tactical positions. So we're not going to day trade this portfolio. That's not how we work. We're not going to take huge swings, where you're 10% down on equity, 10% up on equity the next day. That's not how we work. That's not, frankly, how we can add value. What we will do is, when we do see an opportunity, a dislocation in markets, and I think 2022 is a good example of that. At the beginning of the year, we said, hey, growth equities have been on quite a run. value equities haven't done as well for the last number of years. We think there's an opportunity to trade off a little bit there, and took that position in 2022 over the course of that year. So that's an example of something we'll do tactically to try to add a little bit of value there. Okay? So hopefully that gives you a sense of some of the things that we believe in and what you'd likely see reflected in the portfolio, for the trust. Now, I want to jump ahead to 14, and I've spent some time talking about NEPC and our OCIO business and the like. I want to talk specifically about the trust and some of the features that we've learned so far. We know this is a relatively new pool of assets. We know that you have a distribution rate that it sounds like is 5% gross of fees. We know that, again, you're going to be cash flow positive for a substantial amount of time, which is an important, and unique dynamic. And we know that you're subject to state statutes around what you can and cannot do as far as overall asset allocation. Things like, private markets have upper limits. So those are all things that we know that would influence kind of how we help work with you and collaborate on an asset allocation target and ultimately investment policy statement. And Ryan referenced the concept of this total enterprise management survey, where we're asking you for feedback around investment philosophy, around return objectives, around risk profile, and that's critical to what we do, as well as utilizing all these asset allocation tools that we have that help us gain insights around projected returns, help us gain insights around how a portfolio will perform in different market environments, and then how a portfolio will look under different liquidity situations. So utilizing all those tools, bringing them together for you. And before flipping to the next page, I just want to caveat that we don't know everything about the trust at this point. And so obviously there's an information gathering exercise that comes with this, but we wanted to share with you what's on page 15 and just give you a sense of our thinking generally. And obviously this would be fully borne out as we work with the board. So on page 15, just highlight the four major buckets around asset allocation. First one being public equity. Key points there are it'd be a globally diversified portfolio, different market cap exposures, and as you heard from Ryan, a mix of active and passive management there, based on where it makes sense. Next bucket down, safe haven and high quality fixed income. For us, that means treasuries and tips typically, and all passively managed there, trying to find very cheap market exposure to those high quality assets. Next down is return seeking fixed income. So that's typically global investment grade and below investment grade. So think high yield bank loan type of assets. Things that can earn that 6, 7, 8% that's available in today's market. And then the last piece, which is a sizable piece of the portfolio, is the alternative. And that's a mix of private equity, private debt, real assets, and maybe even hedge funds, depending on conversation there. And, we recognize, that's a big step. Those might be new areas for the board. And so a big part of what we'd have to go through before getting to this is education. What are the pros and cons of going into these certain areas? Obviously, with private equity, one of the pros is we think you can generate higher returns. Well, there's trade-offs to doing that, and they largely center around the fact that you're locked up in that fund for 10 years. And so that's an important thing to go through before, again, those are crystallized in an asset allocation and an investment policy statement. Another thing you had asked us about was, on top of just the asset allocation endpoint, how do we get there? What does the transition look like? And so with the private markets in particular, we don't just go from 0 to 30 overnight. That's a multi-year plan to get there. And we develop what we call a pacing plan. And that pacing plan helps us commit capital each year to get ultimately to that target that we have for private markets. And what that means in more day one is that those assets that are earmarked for private markets will sit in public markets to start. And then as that private markets portfolio is built out, the public markets portfolio will be drawn down as a source of funding such that over 4 or 5 years, get to that end state strategic asset allocation. So there'll be a game plan down there. It'll be well spelled out as to how we would get there in each of those areas. Any questions on the asset allocation and some of the comments I made there?
Things that we were, wondering about, we're pretty sure the portfolio is in a liquid state today. It's probably got some kind of investment program. I just want to confirm that so we don't.
Yeah, I think it's in what?
Is it all cash?
It's like 30-day treasuries or something in it.
Yeah.
Okay.
Yeah.
Great, that's super helpful, thank you. Didn't want to assume that, but thank you.
No, yeah, it's liquid.
So that's an easy transition.
Yes.
I wanted to spend a little bit of time on investment research process, because this is really important and ties back to this alternatives piece, which is potentially a big part of the puzzle here.
All right, so some of you that have the electronic version, we moved a page a little bit back in this section, just to talk a little bit about the physical transactions around this, but this is around, you can skip that one page.
So I'm on, the title is Investment Process Due Diligence, page 16 in the hard copy. And there's really a couple things that we're trying to get at here. The overarching theme is that it's fairly easy to look at a fund returns and compare it to a benchmark and say, okay, they outperformed or they underperformed. But where the real kind of skill comes in is by integrating quantitative analysis and going second level on that. And by that, what we mean is understanding why it happened. Did they generate those returns in excess of the benchmark because they're good stock pickers, they're good at picking the right sectors to be in, their style just happens to be in favor with what's going on in the market right now? Those types of questions that we ask and quantitative analysis that we go through helps us really get at what's going on in the portfolio. And then we're marrying that with the qualitative. And the qualitative is, how does the team function? Who are the key players on that? Is the equity being shared within the organization? You heard from Steve about how we have 48 partners at NEPC, and so that's really served to lock everyone in and make for a stable organization. If equity isn't being shared at some of these organizations, the likelihood that the talent, the next generation, leaves is pretty high. And so understanding those sorts of dynamics is really important to a lot of the qualitative work that we do before arriving at a thesis. And the thesis to us is, how do these folks consistently make money and outperform their benchmark? And we need to develop that thesis if they're going to have a role in the portfolio. Okay. So I think that's more very important to understand. Again, very important as it relates to alternatives, because the difference between picking a top manager in private equity versus just a median manager, it's huge. It's a really big gap. And so getting that right and dedicating the resources to do that is critically important in our eyes. So I'm going to move to page 17, and this goes another layer deeper and gives you a sense, okay, beyond asset allocation, what would this portfolio look like as it's implemented? And we get a little bit more specific about the asset allocation, market caps, style tilts, things like that. You get a sense for that active and passive, so you can see that, for example, the top line, U.S. large cap equity, that's a prime example of a place that we're going to be passive. We think, as to Ryan's point, it's a highly efficient universe. We just want that market exposure, and we want to do it as cheap as possible. And then the next thing is all of this work that we do to really push on fees. And so the right side of this chart, you'll see the standard fee that is out there that managers offer. Then there's the NEPC OCIO fee that we negotiate. And on the far right, you'll see a discount. And that's us working across the board on this portfolio and asset classes to generate reductions in fees. And what it boils down to at the bottom is that for this type of asset allocation, this portfolio, we think there's 14 basis points of fee savings. And when you look at that relative to, I think, about roughly $60 million in assets maybe today, that translates to close to $85,000 in savings, in investment manager fees. So as we think about what we can bring to the table, it's NEPC fee is part of the equation, but it's also what we can do as far as driving down the investment manager fees. And if we can really save you a lot on there, we think that's really critical to the top line, which is generating those net of fee results for you. Okay?
It should more than offset, you think about, there are differences in everybody's fees, right? The fee that we propose, next firm that you're going to talk to, and the one that you probably talked to beforehand, that gap is somewhere around $50,000, right? So if we can drive more alpha and incremental fee savings, that gap goes away. And in fact, it goes away and becomes a big positive for what we're doing relative to what other firms can do.
So I think this brings us to, I think, what is likely a very important topic for you, and hopefully the proof statement for us, which is performance on page 18. And this is the track record that we've generated since inception. And what you'll see is that NEPC is in the dark blue bars, is that over the 3, the 5, the 7, and the 10-year periods, we've outperformed a market benchmark, which we've defined as 60% equities, 40% bonds. And we've also outperformed a peer benchmark here over each of those periods. And so that's, I think we're proud of that again, and we think that's important. What might actually be more important is in the details down below in that box there. And in there, you'll see the column around standard deviation, and that really means the volatility of the portfolio, how much it moves around relative to some of these other peer portfolios or benchmarks. And that's where I think things really stand out, where you can see that our risk, our volatility, is about 20% less than these other portfolios. So we're generating good returns, but doing so in a more stable experience, which we think is critical, because this is a portfolio that's going to be paying out expenses and supporting parts of the community, and having that capital be there during down markets we think is really important. So that stability of a portfolio, that lower volatility profile, is something that we're also quite proud of.
Yeah, Scott, maybe I really want to hit on this, because the one item that I mentioned at the beginning is that we recognize, yes, you're basically a charity, right? You're a charitable trust. You're going to be paying out, around 5% gross. You're also in the spotlight. You don't want to be the folks, and we know this because we work with lots of other public funds, you don't want to be the ones in the spotlight saying, wow, the trust lost 20% of its assets because they took too much risk, right? We fully recognize that and want to design portfolios that are all-weather, that really stand the test of time through, yes, really robust markets, but also really challenging markets. We're going through a challenging market now. The drawdowns are pretty significant on portfolios that are simply equity-centric, right? And I think this is the kind of proof statement that you all should be thinking about, like, okay, how do I build this portfolio to be able to stand up to my community and say we did the right thing, and also be able to say, hey, we're serving our community in a really powerful way when you show long-term outperformance.
So I'm going to hit on one last slide on page 22. Now that we've talked about the asset allocation, and we've talked about some of the specifics of the portfolio, and I'm sure a natural question for you as a board is, okay, how do we get there? And what do I have to do? What do we as a board have to do to get there? And the ask on 22 for you as an organization will be, we'll need a little bit of work up front, and that means negotiating and signing a contract to get us going and put the rules of the road in place, giving us information about the portfolio, anything we might not have already, trust documents, things like that, and then putting us in place with a certificate of authority, the ability to act on your behalf for certain activities so that we can execute the portfolio when that comes to bear. That means then it's on us largely, on NEPC, to execute on things like determining and figuring out with you a custodian, if you need a custodian, figuring out the investment managers that will fit into this portfolio, getting you set up on our internal portfolio management system. And, what we lay out here is really a 10-week transition timeline. I think, given your answer to the earlier question, which is that you're in a highly liquid portfolio today, just in treasuries, that probably shortens this timeline, probably 6 to 8 weeks. So it's a fairly quick transition. And we have folks that are dedicated from an investment onboarding perspective to work with you, to work with us, to make that process seamless and hopefully pain-free for you. And it's something they do roughly 20 times a year, so they've got a lot of expertise doing it. And something that obviously is critical to getting off on the right foot for all of us. So just wanted to share that so you're aware of kind of how it would work in operation.
Yeah, so maybe 2 quick things here. Operation shouldn't be lost on you. And yes, it's easy to say, we'll take care of it. We have a lot of systems and technology that we bring to bear on this, and a lot of people. It can't be lost on the number of people. And, I'm sure Brad did a great job of this, but this operation aspect of what you're doing is really important. Somebody can make a mistake simply because they're working off spreadsheets or whatever they're doing, or sending paper to somebody to get monies moving. And the liability framework in today's marketplace is going to go back to whoever you're working with. You want a provider that's got deep pockets and it has all the insurance. But once you blow through the insurance, what happens? Right, $100 million program, something goes wrong, you get through your $5 million insurance really fast. So making sure you've got a lot of safety nets in place and the right systems in place is really important. And I can't say enough about that because there's a lot of OCIOs, firms, our competitors that are small who can't afford to do the things that we do. So I'm sure, I mean, I know who they are because I'm sure Northern has really great resources. They're a big firm, but I make sure that you dig hard on that as you're thinking about who your partner is. The other part of this is really one of the questions that we skipped over a couple pages here and want to make sure that we use your time wisely. We have a pacing plan in place. In other words, how do you get from zero in alternatives to the long run in alternatives? Do you want us to spend some time on that?
Overview.
Okay, there you go.
Yep, I'll handle that then. So we do provide a slide, it's commitments and allocation projections. And we did want to include this because your peers of relatively the same size and a little bit larger, which you'll be there very soon, this is what they're talking about right now in private markets.
Page 19.
Thank you. Private markets, as Scott alluded to, you don't just invest day one and you get to your asset allocation target the next day. So you're making a future commitment. And those dollars will be called, is the technical term. They'll say, okay, we're ready to make an investment. Please send us a portion of yours. And they will invest that money over a period of 2 to 3 years. With privates, what you have to manage is not only that commitment pace, is that they are long-term and illiquid, but they're finite. That money is going to come back to you, hopefully with a nice return attached to it. And then all of a sudden, instead of a private equity allocation, they're sending you back cash. So you have to redeploy those dollars. So we're going to be managing towards a target. We recommended a 12% allocation to private equity specifically. So it's important to identify managers, to get access to those managers. Again, we've all kind of been in unison, like our size and our leverage in the industry allows us to do that for your benefit. But we have to essentially pace out commitments, again, future commitments, knowing that they will call that money down the line, invest it. Years later, it'll come back to us with hopefully a handsome return. So we provide a pacing plan here on this page. Again, these are very broad strokes, understanding we know a lot, but maybe we don't know everything. But if our asset allocation was agreed upon, you would probably be looking at a $10 million annual commitment to all of private markets. So private equity, private debt, private real assets, if that's what's agreed upon. and you can see, managing to that target. We like to kind of do that in 4 to 5 years.
Is this, I apologize, man.
Please.
The reason I wanted you to overview is because I couldn't understand this
Yeah.
slide.
Sure.
The $10 million total commitments
Yeah.
line that goes across there, is that 25% of the total 52 million? I mean, it's not, but where are we getting $10.5 million?
Yeah.
Is it, we're only getting in $10 million after everything's said and done. What are we, 17 eventually?
Right.
17 million. We're not going to be taking 10 of that every
Yeah.
year, or are you going to be taking 10 of that every year? Because that would,
So the commitment is different than what's actually invested.
yeah, I understand that, because it's not called right away.
Yeah, right. It's not-
But
it's-
I guess what I'm saying is, then this $10 million is the actual commitment you're talking about going to private equity out of every one of our the deposits basically that we get for the next 10 years?
We would allocate 10 million in total, not just to private equity, I just want to be crystal clear, to private equity, private debt, and private real assets. If you want to talk private equity, it'd be like between 4 and 5 million.
All private?
Yeah.
All private?
All privates, and we would commit that on an annual basis. So that would be our target. Now, these are projections. We think our modeling's pretty good because it is pretty concrete. There's a 2 to 3 year investment window. There's a period of 10 years to invest and harvest those gains, and then the fund wraps up a couple years later. So that, from a modeling perspective, is fairly accurate. We are going to review this on an annual basis. We don't set this once and then never look at it again, but we want to get to that target, right? We don't want to constantly be chasing our target. So that's why I would say, look at the first 4 to 5 years here, knowing that we're going to review this on an annual basis, and let's get that vintage year diversification, as it's known. So make some investments in 2024, make some investments in 2025. You'd be surprised on how much vintage year, the effect that vintage year has on future returns. Let's get to target in 4 to 5 years. After about 7 years, we're going to start to see money coming back in. So then you talk about being cash flow positive on the private markets portfolio. So to answer your question, it would be a commitment of $10 million a year, but that is not an actual investment at that time. It's a future investment.
Can I ask you, should we, in terms of the way that this thing lays out, so the very bottom line was the one that I think I was kind of most concerned with. Sure. In terms of how long does it take us to get to that 20 whatever percent, 25%-ish number?
Yeah.
And so would this mean, the way that this is written, would this mean like in year one, let's just forget about dates specifically, but
Sure.
essentially in
year one,
however it gets called or however much we commit to or whatever, we would expect 3% of the 52 million, for example. So we would actually have $1.5 million that would actually be
That's
in
right.
private markets, right? And then the next year it would be 8.8 million, or sorry, 8.8%. But are you factoring into that number the next contribution?
Yes.
Yeah, all right.
So we're factoring in not only the contributions that are coming, but also
More
the
call dollars, right?
spending too, that you're putting out every year.
Oh,
So,
okay, I see.
so we're factoring in all those cash flows, and I know that 10 million seems daunting when you think about 50 million today, but really the 10 million is reflective of not where you are today, but where you're going to be in 10 years. And that's how you want to commit, is knowing where you're going to be with the growth that you have coming into the portfolio.
Yeah, I guess this bottom line there, what I wanted to be careful of is if we get to our number in a 5-year period, depending on how fast the dollars come back to us, but that, I guess the reviews would take care of this, but that's going to be after potentially we're gone as we roll off, over the next 4, 6, 8, however many years, all that kind of stuff. Some of this stuff is going to happen, and what I don't want to have laid out here is the expectation that we're going to continue to make $10 million commitments, even though that might increase the total number down here. You're never going to do that, right? I mean, you're going to base it on where the portfolio allocation is, what the investment policy statement says, all those kinds of things, right?
Yeah.
And if they happen to call a bunch of capital really quickly, and we speed up this, we accelerate the allocation dollars, then obviously we'll reduce the amount that we commit, right?
That's right.
Right.
All right.
Yeah, I mean, to your comment, I don't want to wake up one day and have 30% of our assets in alternatives,
Right.
right? I mean, it's a rebalance. Yeah, I mean, it's a rebalance.
30, we're going to have 30-ish. I mean, they're suggesting 30, but I mean, we
You
don't.
want to have the number that
Maybe
you
25
want
in
there.
private.
You know, you don't want a surprise, and the way you avoid that is having a plan and looking at it. So, you know, if after 22, for example, there's a tough year in markets. So the assets of the pool, maybe they're lower that year. And that means you probably commit a little bit less on a go-forward basis because we're the pool. So we have to consider those variables. If there's any change in the contributions coming in those projections, if there's any change in the, the spending going out. And that's why you do it on an annual basis, so that you don't get the surprise, so that you don't end up waking up one day and seeing 50% in private markets, because that's how people get into trouble with private markets, is they don't have a plan, a strategic plan, and don't revisit it on a regular basis.
Some of these things, you don't get to control the calls, right?
Right,
I mean,
exactly.
So, I mean, that's the part that I want to, I guess the important part of this is great, by the way. I appreciate, this is really good. I'm not beating up on it at all. I just want to make sure I understand it correctly. It's really helpful.
There's usually a lot more that goes into this.
Yeah,
We just give you some
I just
examples.
want to make sure this is for illustrative purposes only, right? To try to get us an idea of how long it'll take us to get there,
I
right?
think the keys are that it's thoughtfully done, and we're not getting overextended, and we're managing our liquidity elsewhere in the portfolio in order to meet those future commitments at hopefully the right level, right?
All right. Good.
All right.
Historically, what's been your 10-year IRR on private equity investments?
The 10-year has been about, I don't think we have the result in here, but we can send it. It's been about 3% in excess of public markets. So in this last 10-year period, it's about 15, 16%. But keep in mind that that's been a robust time period. Public equities have done well, and our private equity investments have done very well. We think 3% roughly over public markets. That illiquidity premium is what we should expect to get for giving up that illiquidity. So it's a big part of what we do. So if you're, obviously, again, we have to go through that education process before deciding on what the right number is, if there is a right number for private markets. But that's an area we've invested a lot of resources, in our research department to find those managers, because we believe that does add a lot of value there.
And it's a direct program, and that might require a little bit of explanation. Direct meaning that we're not investing through a fund of funds structure. Fund of funds meaning you're paying multiple levels of fees just to get access to something. We're building a direct, so we're making the investments directly with the private equity manager, so that we're minimizing those costs, and you're getting the direct benefit of their skill, not somebody else's skill in picking another set of managers.
And if I may, that is a big benefit of our OCIO practice. At your size right now, you may not be able to get access or be able to meet minimum commitments. Within our OCIO practice, all of that goes away. And it's our job to identify the most attractive managers, because there's a lot of disparity in privates, from your best performers, your premier funds, to your lower performers.
Yeah.
And that's what we pride ourselves on.
I want to make sure that's perfectly clear, is that we use the OCIO business overall as the investment arm to get into private markets. It's not just your portfolio and just the next portfolio. It's the $80+ billion and the overall NEPC. We use that leverage, so you may be allocating $500,000 right now to a given private equity manager. And most of the time, if you came to them directly, they'd say, no way, I don't want that money. I want $15 million. So that's the leverage that you get by using an OCIO platform that's well developed.
I have a question on page 18, the investment manager fees that are right. What's that discount?
The discount, the 18.2, I think it is.
So the discount column, Brad?
Right on page 18?
The discount represents the difference between the standard fee and the OCIO fee.
The negotiated.
Yes, so that's what we've negotiated with those managers. So they have a fee on the cover that they put out there, and then we're saying, hey, listen, we have 40 portfolios that we're going to invest in your fund, significant amount of assets, limited client service on their end because ultimately NEPC is the end client. What are you going to give us in exchange for that, in terms of a fee rebate? And that's a big part of, again, our value proposition is really across the board trying to push that down.
So we've got 85% discounts. Give me a live example of what that means.
Sure. So, in the passive space, those numbers look large because, for large cap value equity, for example, the standard fee is 11 basis points, but we've got them down to 2 basis points for a management fee. So that's where you get that 80% discount there, from the standard fee to the OCIO fee.
Right.
So the dollars are smaller there, because you're talking about 11 versus 2 basis points, but the percentage discount is bigger. Where I think you probably see the bigger dollar discounts is when we're talking about some of the active portfolios and where we're going from, for example, in small cap equity from 77 basis points to 63. With an active manager, that actually, the dollar impact of that is actually going to be even bigger.
So I want to ask you, just while we're talking about fees, I was going to knock this out, and then I'll shut up for a minute and then ask my other questions after they have a chance to ask them too. But it looks like your OCIO fee, which is on top of this, so it's kind of a little confusing. That says OCIO fee, just...
Sure.
But your actual OCIO fee back here, is there some reason why it goes from 23 basis points at 52 million and goes to 26 basis points with 62 million? Why would it go up in year 2 with more money? I know it's a flat fee there. It's quoted in terms of dollars, but in terms of percentage, it actually is going up. It seems to be backwards.
So, as you know, we revised our fee from the initial fee proposal, which was a straight asset-based fee of, the blended fee was, at the time, was like 23 or 4 basis points or something like that.
I've forgotten. I don't know.
It's all right. It's all right. No worries.
We'll do a bunch of these, so just, all right. So anyway.
So both of these fees, the flat fees, represent pretty significant discounts to our original fee proposal. And I get what you're saying. When you back into it, it looks like it's adjusting, but what we try to do is measure it out so that by the time we got to year 3, that you didn't see a jump that went from 120,000 to 200,000. Okay. Right. So that's all we're trying to do.
Just trying to smooth it out.
Exactly.
Okay. So look, I don't want to say this and just to get it out here in case I don't know exactly what process we're going to take at the end of the day today and then beyond that, but just. We're at 59 basis points of internal expenses, and I recognize that's going to be a little higher because of the relative number of alternatives in there, because those are obviously the highest internal expenses. But at 59 basis points there, another 20, whatever it is, let's just call it 25 to make our math kind of easy. We're at 84 basis points. Then there's going to be some custody fees on top of that. I guess I would ask, typically speaking, and what you guys see in custody costs, I'd love to hear what your answer is, what you see kind of typically in that. But I mean, I'll just kind of tell you, at a 59 basis points, at an 83 basis point level, on an account that's going to be $100 million pretty soon. I know it's, and again, you guys, part of this is coming from the way I see things in my practice,
Sure.
right? Is a little bit different, and I don't have to deal with custody fees, but we've got, and I don't mean it to come out this way, just kind of just trying to compare apples to apples. We've got Mercer, who's however many trillions that they do this same basic stuff on. It's I don't want to be paying 80 basis points for mostly a target date or a static kind of whatever model that it is with some PE mixed in, or not just say PE, but private markets total.
Yep.
And be at 100 basis points on this, the Raymond James, just good old fashioned simple. I'd have to plug it in. It's 30 basis points for a kind of an ETF and mutual fund model mix. We're way above that, and I'd have to I didn't do the math here to weight it out for the private stuff, but we're north of that just on the internal. And that kind of worries me a little bit, that the internal expenses are higher, and they are way higher than what we're seeing otherwise. Any way we get any relief from that, any way, and I'm not saying, this is internal, I'm not asking you guys to lower your costs. I'm just kind of saying on the internal side, other than just reducing the amount of private stuff, is there any other way that we can address that?
Yeah, there are multiple ways, I think. We'll start with custody because it's an easy answer to your question. Our custody costs range, for your size program, at about 2 to 2.5 basis points. Okay, so it's pretty inexpensive.
Pretty cheap, yeah.
And do you guys do the custody?
No.
Okay.
So that's easy answer number one.
All right.
Easy answer number two is we're going to take some of the work off your lap for your internal costs. Some of that is, I'm not trying to put anybody out of a job. I'm just saying, we take on all the legal work, negotiating contracts, moving money around, whether it's with investment managers, your custodian, whoever it might be, we do all the negotiation of those contracts. And that's all embedded within our cost.
But that's the OCIO fee, right? That's not really the internal expense ratio piece.
So if you pay any of that today, so in other words, if you pay somebody to negotiate a contract, you're probably not doing it for treasuries, but as on a go-forward basis, you would have to pay those costs to negotiate a contract or sign an agreement with somebody. And we put all of that into our fee. We're not adding incremental costs on top of that. Okay. And the last piece, which is also usually the most delicate, is that we're going to take some of the operational work off your lap. That's just the fact of the matter, is that because we're moving all the money around, our job is to make your lives as easy as possible. Okay, and that's like I said, I'm not trying to put somebody out of a job, but we do take work off of people's laps, and they'll be able to dedicate their time and energy to doing other things that are maybe probably grant related or whatever it might be.
I would just reiterate the weight that those private market fees have on this, which you also reiterated. And obviously that would, that's a fee that's 4 or 5 years down the line.
Yeah.
Because again, we're not going to get there for a while. But I would put up our fees against anybody, especially on the passive index product. Look, and I think this is why it's a conversation, and I think Scott should probably be talking more about this than Steve or I. But some clients are more passively aligned. And I think we can start to look at areas where we could increase passive use. I mean, to me, your question is, how do we get fees down? I think with our active fees, for what we're getting in active management there, we think that they're worth it. And ultimately, we're going to measure after fee returns, like net performance, right, after fee. But we can look at adding more passive in areas where we think there's more efficiency, maybe not as efficient as large cap US, and look at having kind of a core index holding, and then maybe still incorporating some active management there. So
maybe a specific question on the just let's look at the private equity piece of this. If you were not using direct,
add another 50 to 100 basis points on top of it.
Basically a fund of funds.
Right.
Would that be more than 175 basis points likely?
Yeah.
It would be, but you're probably not going to see that when people put together estimates. They're going to show you what the fund-to-fund fee is, and they're not going to show you the underlying fee.
Yeah, okay.
So that's why this might look higher, because
I like direct. I mean, you answered the question before I asked it. I mean, I like the direct side of that. I mean, I put it on a big positive side of the column over here. I mean, I like that a lot. But
hopefully there's more positive over there.
I'm not that freaked out about paying fees for getting performance, service, all those things. Obviously, that's what I do for a living, so I better be on the side of that. But I just want to make sure that as we're comparing these things, I've got a good handle on how to get them to apples.
Yeah, no, I think that's right on. Ryan said this earlier, and I want to make sure everybody understood what that meant, is the private markets allocation will take time to get there. So that 59 basis points reflects all your assets being invested in private markets today.
Yeah.
So that fee is actually going to be, let's call it in the low 40s, 42, 43 basis points at the get-go. So it's going to be pretty inexpensive, and we can even make it less expensive. But that's a fully baked 7, 8, 9 years from now type fee, not today's fee. So, Rick, going to your point, I think early on, this program will actually be really inexpensive to run, from our standpoint. One other thing that I think is really interesting is we use State Street as our index provider, and there's a reason for that. I mean, Northern is the other big index provider, and we can get cheaper indexing from State Street. And one of the things that we went back and asked them, they're like, well, we can't give you that fee because that's our OCIO fee. I was like, well, then what am I doing? What are we doing? So State Street is our preferred index provider. We know they can't match, Northern can't match what that fee is. So it's 0.45, which means it's less than 1 basis point to get our indexing.
0.0045.
Yes, that's a percentage, yes. So, I mean, I just think it's really interesting as an arm's length transaction, it's cheaper to do it than going direct. So just bear that in mind, so.
We're about 15 minutes over, so wrap it up.
Yeah, I'll wrap it up. Yeah, absolutely. It was a great dialogue. There are, obviously, we can talk about lots of really interesting and great things, but I think this all boils down to really what we've outlined here on page 24, and you don't have to go there because I'm just going to kind of get it back to you. We have a lot of really great and relevant experience for you, both on the public fund side. You're in the spotlight. Maybe it's not the state public fund like the state of Tennessee, but you're in the spotlight. And you want to make sure that we manage that and make sure that you're put forth in the best light possible. The second half of that is we understand as a charitable organization what that means and how important you are as an organization to the community that you are supporting. Putting those two together we think is really powerful. And there's nobody else that you're going to talk to who's got the kind of skill sets that we have to manage that. The second is having the time and bandwidth to spend with you so that your program really reflects who you are, not who we are. And that's incredibly important to us. That's why, Ryan's only going to have 6 or 7 clients total, not 15 or 20. So that's, I think, really important from our standpoint that we've got the time to spend with you. And the last is being able to plug into a research engine that drives really great ideas in your portfolio. We talked about the private markets portfolio. Building a direct portfolio is really powerful. Don't pay two levels of fees. It's just not, you don't need to. So, use that and I'm sure Brad highlighted this for you, we're really good at what we do. The manager selection, the manager selection drives a lot of alpha, and we show that in the RFP answers. You can see that we're really good at what we do, picking investment managers that actually deliver alpha net of fees. So I'll leave it with that. We think it's a powerful combination. We'd love to partner with you. We think you are in a great position, and we think we can do a lot of great things together. So appreciate it.
Thanks. Thank you.
Thank you. Thank you.
Thank you.
You missed it all. Have any questions?
Thank you. Apologies for missing your presentation.
Let's just start from the beginning.
Let's rewind it,
Glad you're here, Kevin.
Yes. Nice to meet you, Kevin.
Be in the middle of this.
I was hoping not to get the gavel,
Today's not.
Richard's trying to poke the bear.
I would have poked the bear if you would have said, can I do it? Can I do it?
Thanks, Brad.
Yep. I see you in the airport this afternoon.
Yeah, no doubt, right?
Which one of these groups